Good morning or good afternoon, everyone. Thank you, Emmanuel. I am Antonio Tijerino, and I'm here in two capacities. One is as the President CEO of the Hispanic Heritage Foundation, serving Emmanuel as our chair, and two is as Board of Director for the University Systems of Maryland Foundation, which has about $2 billion in assets. Wearing both of these hats, it's my great privilege to welcome you to day 2 of the 7th Annual Hispanic Heritage Foundation's Investors Forum. And again, thank you to Emmanuel, who's our chair, for his vision in creating this important forum, as well as board members Stacy Olivares Castain and Monica Mantilla for steadfast support of this work. They have taken a lead from the board side of things. A special thank you to Veronica Rocha and Claudia Diaz for all of their work to bring us together, and as well to Jessica Herrera. As a newly appointee trustee of the University Systems of Maryland Foundation, who does not have a finance background, yet a position that brought me to their board, I am one of the reasons you do this forum. I am one of the reasons that I need to have this feedback and this guidance, as well as sharing your experiences. I benefit greatly from the knowledge shared alongside of you. For background, the Hispanic Heritage Foundation is an award-winning nonprofit focused on education, workforce, leadership, and culture to meet the Latino communities and America's priorities. Our mission has never been more important than right now during this pandemic, as well as the civil unrest, in addition to the challenges and triumphs of simply being Latino. In the investor community, we understand the importance of representation on what America looks like, and we also, in terms of what America will look like in terms of the Latino community. Yesterday, we kicked off the 7th Annual Investors Forum virtually and had over 128 investors join. I believe that's the most we've ever had. We expect the same level of engagement for today. During these 2 days, we will convene investors who represent over $1 trillion in assets and will provide educational content throughout the series of educational panels. Today's panelists include chief investment officers, portfolio managers, asset management firm founders, and other senior investors from some of the most significant pension funds. We will also be closing this year's forum with a special keynote fireside chat with Jose Minaya, CEO at Nuveen and TIAA Company. Moderating the fireside chat, we have our very own Stacy Olivares Castain, who is our board member and also a board member at CalPERS. We would like to give special thanks to our sponsor this year, TIAA Institute. Thank you to TIAA Institute for your continued support. We would also like to thank our industry partners, California State Teachers Retirement System, State of New York Comptroller's Office, Maryland State Retirement and Pension System, and the New America Alliance. We hope this forum is informative, enjoyable, and most importantly, productive. I would now like to welcome our wonderful MC, Marta Hernandez, founder and CEO of Made Boss, and she is a boss.
There we go, Marta.
Oh, thank you. I'm like, should I be doing this? Thank you so much, Antonio. I'm thrilled to be joining this year's forum virtually, and welcome back to everyone to the second and final day of the 7th Annual Hispanic Heritage Foundation Investors Forum. I hope you're all safe and in good health. So before we get started, I would like to echo Antonio's sentiment and thank the forum's sponsor, TIAA Institute. Thank you for your support. The Hispanic Heritage Foundation is able to provide this educational platform to stakeholders. Gracias. That's because of you. We have several industry experts, as you mentioned, Antonio, joining us today that will share educational content and best practices on investment and asset management. We will have a Q&A session at the end of each panel. So please submit your questions on the window. That way we can answer it live. We will try to answer actually the questions live. We also have a chat feature activated. So feel free to add content, connect with one another, share comments, and make sure it's set for both panelists and attendees to view. That way we can all join the conversation. For those of you just joining, we went over some housekeeping items, and we'll make sure to add it under the chat window so that you can review. We have a short break in between panels, and we'll use this time as a networking opportunity to have informal conversations with a few investors and forum advisors. For those of you who missed yesterday's forum, you are in luck. Joining us during the break, we have a few investors from yesterday's forum that will answer any questions you have. We also welcome today's panelists to join the conversation if your schedule allows. I called it the behind the scenes, but we'll just call it the networking session. With that being said, let's get started with the first panel of the day. We will be opening the day with understanding institutional asset allocation. We have senior institutional investment officers who will discuss their approaches to asset allocation and risk management in light of institutional constraints. Before we get started with the panel discussion, we will have a short 15-minute presentation from David Villa, Chief Investment Officer at the State of Wisconsin Investment Board. Moderating the panel, we have Janet Colwell. Janet is CEO of Girls Who Invest and Corporate Director. She was the North Carolina State Treasurer from 2009 to 2016. Cole serves as the independent chair of IFM's Global Institute Fund, Investor Advisor Committee, and as a director of the boards of James River Group Insurance and Channel Advisory. Cole held publicly elected office in North Carolina for 15 years, including 8 as state treasurer. The first woman elected treasurer, she managed over $100 billion in assets and health and retirement benefits for over 900,000 members. Cole is a graduate of the University of Pennsylvania and earned her MBA and MA in International Studies from the Wharton School of Business and the Lauder Institute. She chairs the executive board of the Wharton School of Business. Thank you, Janet, for joining us. Take it away.
Thank you, Marta. Appreciate the opportunity to be with all of you at the Hispanic Heritage Foundation. I love the mission and the leadership that you're exhibiting out there in the industry. And obviously, shares a lot of my core values of the public pensions, public institutions, private family offices. So I'm glad that we've got a great group of chief investment officers, directors of investment, senior panel today. I'm going to just briefly introduce them. I believe there's bios connected to all of them. And then I'll hand it over to David Villa to do his brief presentation before we get into the questions. First, we have Jesus Arguelles, who is Director of Investments at the James Irvine Foundation. And prior to that, he was at the Ontario Teachers Pension Plan and Private Investments, and then has also been with the California Public Employees Retirement System. So a lot of deep expertise in private equity and public plans. Next, we have Scott Chan, who is the Deputy Chief Investment Officer at the California State Teachers Retirement System. He also he's more in the public markets, and then has also worked at the University of California Regent System, as well as the Sacramento County Employees Retirement System. We also have Thomas Clancy, who has a CFA, and he is the Chief Investment Officer of the Pennsylvania Treasury. And he's got 2 decades of professional experience working in the public treasuries, as well as he had worked for Thomson Reuters prior to that. We have Robert Sinclair, who is the Chief Investment Officer of a private family office. He is also the Chief Investment Officer of Dev Carrera, a Canadian real estate developer. And last but not least, we have David Villa, who is the Executive Director and Chief Investment Officer of the State of Wisconsin Investment Board. Prior to being in Wisconsin, he was also at the State Board of Administration for Florida. So yet another example of someone who's had a long tenure in the public sphere, and then also worked for UBS Global Asset Management. So we're fortunate to have all of these gentlemen with us today. I'm going to turn it over to David to share some of his thoughts on the markets, and then we will go to our panel. David?
Sorry, one of the favorite phrases now is you're on mute, or can you see me? Or what do you want from the grocery list? So I've got just a few pages here. I'm really honored to be asked to come and speak with the esteemed panelists today. I want to be a little bit provocative. The risk of being provocative is that I may not be invited back, but I think it's important to put some important issues on the table. So if we could go to page 1, I want to start by saying that underfunding overwhelms asset allocation. The perfect asset allocation will not fix an underfunded pension plan. And this slide attempts to illustrate that. On the left-hand side, there's a bar that's broken down into a green portion and a gray portion. The green portion is the contributions, and the gray portion is the investment returns that are earned on the contributions over a long period of time. So what that bar represents is the contributions are the premiums for an insurance product that takes the form of a guaranteed annuity, and the gray is the investment return. So the cost in terms of premiums is 25%. If you decide not to pay all the premium and your insurance is reduced, you end up with a funding deficit of 35%. So your cost goes from 25% to 51%. So you've got 16% in the green area, 35% is your funding deficit, which is the amount that you did not earn in investment returns, and you only earned 49% instead of 75% on the premiums in the form of investment returns. So if you go to the bottom of the page, you'll see that the decrease in funding goes from 25% to 16%. It looks like you've saved 9%, but in fact, you've increased your cost from 25% to 51%. That's a 26% increase. So the last line on this page is we divide the increase in cost, 26%, by the savings and contributions of 9%, and the cost is 2.9 times what you save. So every dollar that you don't contribute to contributions results in an increase in cost of $3. So there is no rational reason to allow pension funds to be underfunded. And in the extreme, you're transferring wealth from younger taxpayers and younger workers to older workers. And you're giving older taxpayers a break because they haven't paid the freight. In the extreme, like you have in Kentucky and Illinois, I believe that's indistinguishable from stealing. So if that is the opening, I'll go to the next slide. This slide just shows 3 different scenarios related to the COVID-19 pandemic. There's the best case, the base case, and the worst case. And the third column from the left shows earnings per share. In the best case, $152, in the base case, $95, and in the worst case, $70. And then I show speculative defaults, 9, 14, and 18%, and unemployment, 6, 9, and 12%. So the point on this page is that the range of outcomes going forward from here is very wide. There's a lot of uncertainty. So an asset allocation needs to take that into account. The next slide, please. However, there's a very interesting phenomena that is partly related to this very low accommodative interest rate environment. If you go to the middle bullet point, you'll see a table, and that table, each row represents a cohort in the time horizon. So 0 to 5 is 0 to 5 years, 6 to 10 is 6 to 10 years, 11 to 30 is 11 to 30 years, and 31 to infinity is the terminal value of this horizon. And you'll see that only a very small amount of the value of the equity market This is a valuation decomposition of the time horizon for the S&P 500. You'll see that in the 0 to 5 year time frame, it's a very small percentage of the value of the S&P 500 that falls in that part of the time horizon. And the variation across those different scenarios is quite small. So the left-hand column is the great financial crisis. The 9.9% is the base case, 8.7 is the worst case, and 13.4 is the best case. So the takeaway there is that we have to invest for the long term. We need to stay the course. We need to stay with our policy portfolio, and we shouldn't panic and de-risk. That is not wise. The fundamental value does not change very much over time. It's the risk premium, or what I like to call the fear-greed factor, that is very volatile, and price will be volatile around fundamental value, but fundamental value changes slowly, and it changes because the long-term dynamics change, not because of what happens in the short term. So if we go to the next page, we'll see the asset allocation for the state of Wisconsin Core Trust Fund. On the right-hand side is the asset allocation as of September 31, 2009. And it looks very, very standard. It's a classical asset allocation. I want to draw your attention to the bold numbers at the bottom. There is no leverage in this asset allocation as of 2009. The 5-year expected return is 6.3 using today's investment expectations. So it's lower than our 7% actuarial required return. The expected policy risk is 12.3%. And the factor allocation to equities and fixed income is 66-34%. The 66-34 adds up to 100%. And the contribution to policy variance, or what we sometimes call the risk, 91% comes from equities. So a very high percentage of the variability of your returns is coming from the equity sector. Now, in 2019, I have the asset allocation that was actually put in place starting in 2010. And this allocation uses leverage. You may have read in the financial press that the state of Wisconsin uses a risk parity light asset allocation, and that's what this is. So again, I want to draw your attention to the bottom of the column titled December 31, 2019. And you'll see that the expected 5 to 7 year return is 6.2%. It's 10 basis points lower than the asset allocation from 10 years ago, but the expected policy risk has fallen almost 1% to 11.5%. And volatility is actually a cost. We describe that cost using something called Ito's lemma, but I'm not going to talk about that today. And then below that, you'll see the equity fixed income factor allocation is 64% equities, 46% fixed income. So you'll see that the equity factor allocation has only fallen 2%, but the fixed income allocation is 12% higher. That's because we're using leverage. And if you go up above the bold numbers, you'll see the policy leverage of 10%. If you add the 64% and the 46%, you come up with 110%. So our gross exposure is 10% higher than the classic asset allocation, but it has a high allocation to fixed income. It also has a high allocation to inflation-sensitive securities, primarily TIPS. And finally, at the last row, you'll see the contribution of equities to policy variance has fallen from 91% to 84%. So this is a different than the classic asset allocation. This asset allocation will not overcome underfunding, but it has really served the state of Wisconsin very well. I'm not going to go through the remainder of the pages, but on the next page, I have the performance of our fund relative to the Callan Fund sponsor database. Well, here it is. And you can see in the last 5-year time horizon, our fund ranks in the 12th percentile and over 10 years in the 29th percentile. So basically, we've built an asset allocation it's a race car. It goes around the racetrack, and on the straightaways, it usually lags behind the other race cars. And then when it comes around a tight corner, it performs very, very well because of that high allocation to fixed income. So that's the context for our conversation on the panel, and I'll turn it back to Janet.
Great. Thank you, David. Appreciate, I have 2 major points about funding these plans. And if you don't fund it, it's equivalent to stealing from the younger generation. And the second, which is the advice that you shouldn't overreact to the current market volatility or short-term issues, that you have to think about the long term. So I'll use that as the segue to turn to the panelists and ask each of you, and Jesus, maybe we can just start with you and go in alphabetical order here. Can you speak to, it's been a very volatile markets and economic situation. What changes are you making in your asset allocation, or have you made changes?
Well, good morning, everyone. First of all, Mr. Villa, thank you very much for a very thoughtful presentation. I think your summary of the cost and opportunity cost of making short-term minded decisions was really well laid out. So thank you. One of the things that I've learned now moving to a foundation is that our liabilities look different. And so to answer your question, we haven't done much. The reality is we have, with our greatest risk actually being liquidity. And so we've been very focused at managing that liquidity during the crisis. And thankfully, because our liability is variable, we've been able to continue to invest in riskier assets for the long term, trying to maximize long-term returns. So we're still overweight private equity, still underweight fixed income, and equally weighted on our hedge fund and public equity book.
Okay, so you're sticking the course.
Exactly. And especially since this crisis, the COVID, sell-off was very quick, and the rebound's been equally as quick and historic.
Okay, thank you. All right, we want to move on to, I'm going to hide the screen here. Scott.
Thank you. And again, thanks, David. I really enjoyed your comments up front. I'm thrilled to be here. So thank you for inviting me. In regards to asset allocation, I think maybe similar to some of the other panelists talking already, we really believe in 3 things, which is diversification, rebalancing, and the value of our staff. So we're not making very much changes, if at all, to our asset allocation because we think in the long term, we want to maintain a diversified portfolio and we want to rebalance it around the different corners, the ups and downs of the market, and remain disciplined. That being said, I think to the point of the value of our staff, one of the things that we've been doing in the upcycle and the down cycle is trying to take more of our assets and manage them internally. We've been calling that the CalSTRS collaborative model. And certainly we're seeing a lot more opportunities to do that in this situation. So I think the way we've viewed it, and I was actually here last year on the panel, it was sort of surprising maybe to some, but not us, that we had a contest within CalSTRS, and essentially our best idea was to prepare for the next recession. And we didn't prepare for a pandemic, obviously. That was kind of a shock. But I think to that point, the biggest issue that we saw was essentially managing liquidity through a crisis. And that was one of the lessons learned, I think, in our past episodes, that you really have to develop a plan to manage through your liquidity in stages. And so fortunately, we had a year in advance to think about the plan. And I think one of the benefits we have now is we're in a significantly better position from a cash and liquidity perspective than we have been in the past. And I guess we've been seeing it in stages in the sense that everyone, maybe not including us, we're looking to raise cash, make sure we can pay our benefits, make sure that we can weather the storm, and rebalancing on the margin through derivatives. Then essentially, as we roll through this crisis, we'll look to take profits on some of the areas like fixed income, RMS, which is our risk mitigating portfolio, and move it more into less liquid assets over time. And I think we're sort of in that still that uncertain period in our opinion.
Great. And just briefly, since we've got you, when you talk about valuing your staff, we all know that state government budgets have been hit hard. Is that going to impact you in terms of the ability to retain and hire staff?
Well, I think that it could on the margin. I don't have a crystal ball, but in the same regard, we believe that working at CalSTRS is a fantastic opportunity for most people. I would say that the majority of folks that join our organization are not likely joining simply for the compensation. So I think that we offer, if I were to look at public pensions in the U.S., we're likely very, very, very competitive, if not on the higher end of the compensation scale. But I think folks are really attracted to CalSTRS for the mission that we serve. We're the largest educator-only pension fund in the world, and they join because of what we're doing. I think we're an innovative organization, and we're doing more and more direct investing, which I think is attractive for a lot of investment professionals. But we'll see. I mean, the state deficits, that's a big hole. You've seen all this fiscal and monetary stimulus, but one hole that's left out is funding the state budget deficits across the U.S. And they're, obviously, as everyone knows, they're a large contributor to GDP.
Thank you. Thomas Clancy, CIO at Pennsylvania Treasury, and maybe you can speak to it sounds like managing liquidity has been top of mind for our two previous speakers. Maybe speak to that and other changes you're making.
Sure, absolutely. First, thank you to the Hispanic Heritage Foundation for the invitation. I'm really excited to be participating in this. And also, David, thank you for wonderful comments to get us started there. I can't reiterate enough that, especially as a trustee, something that's really important is to understand your liabilities. And any investor needs to understand what it is you're trying to accomplish and what your primary objectives are. So make sure you understand what you're investing for, and make sure you have the liquidity needed, and that means being able to access the cash you need when you need it. Because I manage a diverse number of investment portfolios, and we do everything from, a multi-billion-dollar operating cash pool, which is managed internally, to insurance pools, which are largely fixed income with a little sleeve of equity, to post-employment retirement benefits, which are largely longer-term equity-driven, and 529 plans, which are larger equity allocations. But you do need to look at your diversity and understand how your mix of assets is going to help you achieve your objectives. And what we found in the last, especially in March, is that all segments of the market, even markets that had been liquid and we could access in the great financial crisis, they froze up this time. So we've spent, after a decade of, or near a decade of zero interest rates and ultra low interest rates, it's pushed investors into taking more risk in their portfolios than I think they appreciate. So David had the chart from Callan up there. One of the charts that Callan has published in the past shows what the amount of risk you have to assume in order to generate that same 7.5% return that is the standard for most pension funds. And over the last 20 years, it's increased each year. So if you compare where we are right now to where we were in 2000, you have to take 3 times the amount of risk to achieve that same 7.5% return. So you need to make sure you understand the risk you're assuming when you make your asset allocations. And it's really difficult in these environments where interest rates are so low that you can't always depend on the fixed income portion of your portfolio to generate the returns that it has in the past. That then becomes more of a liquidity ballast, which is going to be more focused in government securities that will have liquidity and have had liquidity. There were a little bit of hiccups in even the treasuries in the last, I would say in March. They quickly resolved, and we saw with the Fed coming in to backstop a lot of the different asset classes that markets quickly regained liquidity, even if spreads were wider. But what I would say is we were surprised. All sorts of municipal securities could not find a bid and saw higher interest rates. Commercial paper was difficult to trade. You couldn't find bids on even highly rated commercial paper. Just nobody wanted it. So nobody wanted anything that was not a government security. So I would encourage the audience and then the people that are acting as trustees to make sure you understand your liabilities, how you intend to meet those liabilities over time. Because if there is a crisis and the Fed is not fast enough to act, you're going to need to draw on some unexpected resources to get there. And what I would say in terms of what we're doing to manage things through this, or reflecting on the lessons learned through February, March, and April. One thing we're doing is reevaluating the liquidity of the assets and the tools we're using to generate our returns. And I think one of the byproducts of that is we have a bias to more liquid securities. So we are repositioning not our broad asset allocations, but the implementation of those asset allocations. We're taking the rebound in the markets as an opportunity to reduce some of our riskier bond positions, whether they're bank loans or high yields, and just marginally at the just on the margin. But we're taking that not because we want to, but because when you're operating state funds, and you often wind up with pro-cyclical behavior, which is your participants and the agencies that are giving you money to invest, when the state funds are and state revenues are uncertain, they're going to start drawing down those at a much steeper rate. And I think the models we had been working off of were not as robust as the information we have now. So we've taken this opportunity to build liquidity within our portfolio and just reposition some of those sub-allocations and make sure we have the rebalancing policy is doing what we want it to. I think we've effectively rebalanced through this based on both calendar and certain change in valuation metrics that we have that guide our rebalancing strategy. But I think it's really important. One thing our staff reflected on is, do we have the correct rebalancing strategy in place? And we are reviewing that, but that was really helpful in forcing our hands, because there was a lot of uncertainty through the end of March, and had we not had those in place, we would not have been, I think, as eager, or we would not have been as aggressive in making some of those changes that really helped the portfolio position itself on the rebound. So I'll end my comments there, but I think this was a little bit of a different beast, and I think there are some lessons to be learned from it, and certainly echo the comments of others with regard to understanding your liquidity.
Thank you. All right, we'll turn to Robert Sinclair. Do you want to? You're at a private family office, so tell us how you have been managing the last few months.
Sure. So first, thank you for the Heritage Foundation for inviting me today. David, was a lovely presentation, and Janet, thank you for keeping us in line. So family office, but we also do business with institutional investors as well. Last year, the returns for the equity side and I guess other kind of industries didn't make sense to us because the returns are quite high, and it really didn't match the fundamentals of the actual businesses. And early this year, we did an look at our portfolio and the equities, and we thought they were going too high. So we sold most of it in February, because again, it just didn't make sense to us. So we took a lot of money off the table. Plus, we were watching what was happening in China. I'm a scientist by education. I study epidemiology. So it didn't look good to me, especially what was happening in Italy. And again, the valuations didn't make sense. So we took the money off, and we thought that once it kind of spread more around the world in the US, the market would crash. And we didn't think that the Fed would jump in as quickly as they did, because in 2008, 2009, it took quite a lot of months, and this time it didn't take much time at all. I guess they learned in 2008, 2009, so we weren't able to be as opportunistic as before. And now you see the stock market, I think, too high now again. It just, again, doesn't make sense to us. And we don't like to invest in things that just don't make sense. I mean, some of the valuations are just silly. The debt, a lot of people are getting into, a lot of people are buying companies that are bankrupt or going bankrupt, and it just doesn't make sense. So what we're looking at is actually doing a lot of investments as in hard assets, or I guess one thing we're doing is we're looking at buying some land or some properties that we're using, getting a loan from. We have people already buying the land once we purchase the land, so we already cover our risk. So if the land that we're buying costs $10, the valuation is actually 4 times that, but we have somebody coming in to buy a quarter of our land for the purchase price of what we're buying it at. So that's how we can make money but reduce our risk, but still a loan to value at a very low risk. So we like to do things that make sense, that make sense with regard to supply and demand and demographics, and profit is very important to us, especially when costs are involved. So again, it's I have no idea what's happening in the stock market. To me, it makes no sense whatsoever. But even if we did go buy something in the stock market, we would look at the business as it is, not what we think it's going to be tomorrow. As some of the other people said, it's what's going to be in the long term. But right now, I don't know how long this is going to go on. 10 years ago, 2008, 2009, it was a lot easier to figure out how long that was going to take. But now we have a virus, and no one knows how long that's going to go on for. No one knows how the countries are going to react. No one knows if it's going to be locked down again like it was before, or maybe it's targeted. No one knows how long, one company fails, and therefore, if you look concentrically, you have the other companies that feed those companies. And if they go under and so on and so forth, and people take on debt, I have no idea. So until I get a better understanding of where the virus is going and how companies are reacting, I think I'm going to stay away from the equity markets at the time being. I'd rather make less money a little bit later than lose a lot now.
Yeah. So, Robert, you've made some sort of provocative comments there too. So I guess I would throw it up to the rest of the panel to say, okay, so if you need to have a return and you have to risk up your portfolio, and yet you also need liquidity, but you think, according to Robert, right, that the equity market may be overvalued, how do you handle that? I mean, David's got leverage on his portfolio. Not everybody is able to do that. How are the rest of you threading the needle here?
Well, this is Tom. One thing that we did, so we did de-risk our portfolios a little bit back in the third quarter, and I wouldn't say all of our portfolios, but our 529 plan in particular, we had a surplus in that, and we used some of that surplus to buy down our expected rate of return. So what that means is you reduce your expected rate of return, that also reduces your overfunding. And we took some of that, some of our assets and moved them to minimum volatility, particularly international assets. We moved to some minimum volatility products for that. So it gave us the economic exposures we wanted to those emerging markets, to those international markets. But you're going to be more focused on utilities, consumer staples type names that don't have the volatility of a lot of the industrials or the the consumer discretionary names. So it's slightly different exposure, but it did give us the economic exposure we want, and that helped us reduce the beta of our international exposure on the neighborhood of, depending upon which product you choose, it will reduce it anywhere from 25 to 30%. So it did achieve what we wanted it to, and that was one way we were able to have the confidence to remain in those markets and stomach that volatility, because it was diminished to some degree by those products. That was one way we achieved it.
Scott?
Yeah, thank you. So I think that you're just seeing a real diverse panel and different ways of managing institutional assets. And for CalSTRS at roughly 250 billion, we can be sort of tactical on the margin, but you can imagine that deploying that amount of capital is going to be difficult to execute the strategy that Robert is. And I think we look at the world more from a fundamental bottom-up perspective. If we looked at the sort of the pyramid of things we think we can assess and what we're going to be good at assessing, the markets would probably be the least. We consider ourselves least capable of the market. Less capable of predicting countries, less capable of predicting sectors, but very capable of predicting more companies and specific transactions. And so our team is really focused on finding the best values in terms of the specific transactions that we can find in the market. And so we're organized with roughly 180 investment professionals, each with expertise across the different asset classes, with a fairly wide net of partners to find essentially the best opportunities. One of the things we're doing now is because we didn't start with a large private credit or private lending footprint, we are looking at that space mainly in areas where we think we can be more senior secured, generating a moderate return. This is not like the last crisis. I think that a lot of people had asked that. The opportunity set doesn't seem to be as robust in terms of writing equity checks yet, because there's so much uncertainty. But I think there's a narrow amount of things that we sort of know and interesting opportunities, and a wide amount of uncertainty, because the root of this is a pandemic. It's not a financial crisis. So can you predict when there'll be a vaccine? Can you predict when essentially if there'll be a second wave or not? Can you predict kind of go down the line? It's very difficult to predict the pathway. So we're just focused on the bottom-up transactions and towards private lending and private credit. We're looking to deploy roughly $3 billion or so in the initial rounds, and we're doing it in our sort of more direct CalSTRS collaborative model, looking to try to lower some of the costs by doing more co-investing. In some cases, we're launching. We're going to be launching BDCs or be invested in the asset management companies themselves.
That's great.
Maybe if I can add a perspective from a foundation, I think the point being that, I think different sizes, different types of organizations can react differently. When I think about our asset allocation, strategic allocation, the board has been very helpful at setting those boundaries. What works for them in terms of risk tolerance? What are the objectives that they want us to manage to? And I think for us as a team, we've been able to really focus on what do we think for the long term? What are the investments we can do today that will still yield strong returns? And frankly, we've been leaning into technology more and more. I know everyone is, but because of our size and scale, we're able to really invest in venture capital. And so we're leveraging our strength as an organization to say, where can we continue to deploy? And so actually, akin to some of the work done by others last year in terms of preparedness for potential downturns, we look back at cash flows during 2008, 7, 8, 9, 10, and really it was very interesting. It showed that venture capital, some of the best deals were done during that crisis period. Now, it was different than today, as we talked about, but venture capital had yielded some of the best, unicorns that we all know today during that period of time. And so our view is don't run away from that kind of risk, because that is the future opportunity. And that, frankly, the whole concept of technology, software eating our lunch and eating the world is only been accelerated by this specific pandemic. And so, and that's caused that's been a really good problem to have in the sense that because others are leaning into technology, our portfolio continues to perform quite well. But we're also mindful that if the broader world suffers, we're all all assets are going to be impacted, all values are going to be impacted.
Can I add something to the venture capital, if you don't mind?
Please.
So I'm involved in two right now, and I've had a lot of discussions over many years with a bunch of people who try to get me to invest in venture capital. And some people, many of them used to say, it doesn't matter about the profit. We just want to make sure that it gets to a point where it can be sold to somebody else. That to me, I see, Jesus, you're laughing. I think you agree. But venture capital is very much of, if the company has a good idea and it has good economics and and there's a demand and you can supply it and you have a path to profitability, go right ahead as long as you de-risk it all. But if you can't answer those questions, I'd stay away.
And to be clear, there's a significant amount of value lost in venture. And there's a small percentage, I think it's like 5% of assets that actually make all the profit. So you have to have access.
Yeah.
But I mean, it's really, there's a reason why people invest in venture, I guess is what I'm trying to say. There are firms that are generating, 5X type fund returns through their investments.
One of the ways we help to reduce the risk is that we would only invest in a venture that we actually have expertise, that we can actually help or see that we know that the venture is actually going to work, either by our expertise or by our network to help actually commercialize the thing.
David, just curious with Wisconsin on the two themes we've been talking about, technology, are there strategies through public or private markets to sort of overweight tech? And then also, how do you view venture capital?
Well, so I'm gonna skate back a little bit and say that what Robert is doing makes a lot of sense. I think one of the things that you can do in this environment is provide liquidity to asset owners who have balance sheets that are stressed or who need liquidity. And if you can find transactions that provide liquidity for those asset owners, you will be paid way above what is fair in terms of risk premiums and premiums for default and term and whatnot. So I think that's a very, very nice strategy. For us, at $120 billion, by the time we see those kinds of transactions, and they need to be large and complicated, we're almost participating in an auction, and a lot of the juice gets competed away. So that's a more difficult strategy for us to execute, especially in the context of other large investors who don't have a 7% cost of capital like we do. In terms of technology, we like technology. We think it's really cool that entrepreneurs or professors at Stanford can create 3 companies in their garage and lose everything, and then work with Sequoia and create the 4th company in their garage, and we can participate and make money. That's rare, but we actually changed our legislation so that we could get an exemption from the Freedom of Information Act, FOIA, so that we can improve our access to the top tier managers. In some cases, it's taken us 6 to 8 years to get access. We just hang around the honeypot and give them cheese and beer and brats and badger pins, and eventually they let us in, so we'll go away. But that's worked out very well. We participated in some of the big IPOs. The challenge is we probably have $1 billion in venture capital. So it's really hard to move the needle on a $120 billion fund. The very best managers are rare and they're expensive. And they're limited in capacity. I think so. We like technology. We think technology in the public markets is overvalued. In many cases, you have the big growers with earnings, and then you have the big growers who don't have earnings. and we don't understand how they could be valued the same. So I think our performance on our internally managed funds has suffered because we're not following the herd, and that's somewhat painful. I think if you noticed in my 2 asset allocation solutions, our expected return with both of them is only 6.2%. So we need to earn about 60 to 80 basis points from active risk or active returns, and that's been challenging because the market is narrow in breadth. The public market is narrow in breadth, and the private markets are very expensive. Did I answer the question?
Yeah, I mean, I think, believe me, having run North Carolina, I know the difficulties of VC and the FOIA issues. Congratulations on being able to get the legislation through and gaining access to that space. So it's a difficult one to navigate when you're 100 billion. I just, in the folks from Hispanic Heritage tell me in terms of time, but I wanted to just, before we get to Q&A, throw out to the panel around inclusion and equality in the asset management space. We've just gone through a number of weeks of kind of a national convulsion around reason. A lack of equity. And I just wanted to ask all the panelists, how do you think we can make the asset management industry more inclusive? And I know a number of you represent organizations that have certainly been leaders in a space. Would love to hear your words of wisdom right now.
Well, I would respond by saying, I think as leaders of real money asset owners, I think we need to take it upon ourselves to drive that. I don't think it works very well to try to force external asset managers and GPs and hedge funds to do it. I think we have to provide the leadership and do it ourselves. I think in Wisconsin, I recruited Dominic Garcia from New Mexico. He worked for us for 10 years, and now he's a CIO in New Mexico. And I think, identifying talent, developing the talent, and then sending it out into the shark-infested waters is a large part of what you have to do. I think we have tried to work with Girls Who Invest, and it's been very, very frustrating because your talented, I don't know what you call it, participants, team members, the women that you bring in, they're already spoken for by the big asset management firms. I'm like 10th in line after Goldman and Morgan Stanley and BlackRock and Blackstone get their pick of the women. So I really can't play in that pond. Yet I think we train people to be real money asset managers in a very humane culture and environment, which I think many people would enjoy. We have a lot of people from hedge funds with PhDs who've really enjoyed transitioning to our platform. I think, and then I'm very frustrated with the local universities in Wisconsin. They do a very poor job of providing the raw talent. And again, in the programs that are competitive, the students that I want them to recruit go to Stanford or Harvard or Wharton, and Wisconsin's unwilling to compete. The way I think the universities that I attended competed for talent. So that's my reaction. I think we should provide the leadership as CIOs and leaders of real money asset managers, and not twist the arms of external managers.
And if I could just expand on, if I echo what David said, absolutely, we need to be the change we want to see. So we need to groom that talent, hire it ourselves. One thing we've begun doing within Treasury and also among some of the pension funds on which I'm a trustee is incorporating some of the due diligence questionnaires. I think ILPA has a really good one that also asks about the service providers to your institutions, ask them about their diversity practices and their hiring practices. Some of the work we've done with the 30% Coalition has expanded beyond just women, and we are beginning to take a broader look at diversity and inclusion using some of those same strategies. One of the interesting things we're developing is a dialogue with the private investment community, and what we're really aiming for there. So we are. The 30% Coalition is focused on board seats in particular and putting diverse people on those boards. But what we're also finding through those partnerships is that how important it is to have management in those companies that are diverse as well. So you need to create a culture within the company which sees diverse management. And it's not unusual for a woman or a person of color to be in those management positions, and we've seen that in order for it to be effective at the top, it has to be a culture throughout the institution, and there are certain practices you can do. And we're beginning dialogues with the private investment community to better understand how we can help them develop those models and develop the talent that I think they want. But as David pointed out, it's really hard to come by, because they're not always coming out of schools in the same ratio, but we can do what we can within our positions to ensure that we're furthering that dialogue and making the changes within our institution that we want to see.
Scott, yeah, please jump in.
Yeah, sorry. Yeah, I really agreed with David's comments about that we need to be the leaders. And I think that, like most people, I'm saddened and angry at the current environment and what it's been revealing, that we've left a lot of folks out of the economic engine. And more important than that, we've seen social injustice and in just basic liberties like life. So it's very a difficult time, and I want to acknowledge that. In our small corner of the world, we just start with the premise that we want diversity to be the majority, and essentially what that means is we know that a diverse team is going to lead to better decisions in the majority of cases, and so our culture and strong value at CalSTRS is sort of a push for diversity because we want to see that, and because we're bringing more of our assets internally now, we're over 50% kind of internally managed, if you will. It starts with our own workforce, and we've made a lot of strides. I think strides to have a diverse workforce. Though we're not perfect, and we keep learning and growing in that sense. But I think we've done okay in terms of hiring women as well as having a fairly diverse workforce. We have roughly 50%, a little bit over 50% of our workforce is women, and roughly 47% of our workforce identifies as ethnically diverse. The other aspect is then trying to be a leader within the industry, and I think a lot of folks already know CalSTRS and what we've been trying to do, but we have a fairly robust emerging manager program. It's roughly $12 billion. It's over 10% of our externally managed investments, and we continue to support and maintain that program. We're also part of a lot of organizations, including the 30% Coalition that Thomas was mentioning. But I think our latest push is really focusing on the private markets and the private companies, and looking to make progress there, because so much more of the market now is held in private companies, not public companies. And so what's the diversity on that leadership set in those boards. So we're starting to work a lot more on that end of things. That's probably the new thing for CalSTRS in comparison to what we've done in the past.
Can I?
Some of our foundation friends, yes.
Can I just add something? So my son, who's 8 years old, asked me a question a couple of days ago. He said, "Why is this happening? Racism and prejudice?" He said to me, "It's kind of stupid and it doesn't make sense." And I said to him, "You're absolutely right." I said, "A good idea is a good idea." He said, "Well, why are people doing this?" And then I explained to him the ideas of ignorance and fear, and explained to him what that does to people. And I think leadership starts at home. If you don't teach your kids, and then follow through and actually do what you talk about, then your child is going to grow up and say, "Okay, my dad said one thing, but he actually did something else." So I really think it all starts from home for everybody, because a lot of people say, but they don't do. And I think that's one of the big problems. And the other point is the silent majority. A lot of people disagree, but when things like this happen, they don't speak out. You're kind of complicit yourself anyway. And that's not a good thing.
So in terms of, I saw a couple of comments also on actually getting capital, not just recruiting. I will just quickly say from a recruiting perspective, I am the product of an organization taking a chance. And I saw Giancarlo Marx spoke yesterday from Upwelling Capital. He and then now or former colleagues were people who gave me a chance to come in without a strong finance background to really learn the business and really apprentice up and get a chance to go to Canada. I will tell you just really quickly, coming back from Canada, it was shocking. The correlation between economics and race blew me away again. I had forgotten it moving up to Canada and being up there for almost 6 years. So all this to say is I think people are waking up, and I know organizations like the James Irvine Foundation is being very vocal, and we're putting our money where our mouth is in terms of our grant-making dollars. Now the question comes on the investment side. We focus both at the staff and out at our managers on cognitive diversity, which then yields visible diversity or people of color diversity. And I can tell you, I'm very proud. We don't disclose our portfolio publicly, so I'm very cautious about releasing names. But I can tell you that there are people. We're backers of people, women and ethnic minorities in our portfolio, and they are generating the returns. One of the challenges I have seen has been this disparity of performance that was actually discussed yesterday is real. I've seen it, and I think I will just reiterate that talent becomes very important because, there was an article that Robert Smith was quoted in saying he was thankful for the internship he got at Bell Labs. And so when we think about how to give dollars to people, it is actually starting with things like internships, both at portfolio companies and at investment firms. And also recognizing, as David pointed out, talent is difficult to attract. It's been difficult to attract the last 5 years. And we've faced that both internally and with our managers. So I'll pause there, but happy to follow up with anyone if they want to go in detail. Something we as a team, investment team, are very passionate about. The last thing I'll just add is the bar is very high to add new managers right now. Some Marcos, who's on this, knows, we have not been allocating to new managers recently because we have so much exposure to private markets. We try to be very active, but it's been very difficult because our portfolio has been performing. So I'll leave it there.
Oh, that's great. So I guess the one last question for everybody, since Jesus brought up the capital side, many of you spoke to the leadership and internal hiring. Are you finding that emerging manager programs are something that work, or how are you thinking about inclusive allocation of capital?
Well, Janet, one thing I would say is we've taken steps to make sure that there are diverse managers included in every search we do when we do a management search. And like I said, we've expanded it beyond just the managers, and we want to understand how are they scrutinizing their service providers? Because the financial services industry is more than just the investment managers. There's a lot of other opportunities within financial services supporting that, and I think there are opportunities to support diversity all the way through the industry. So I think those are the things that we've done to ensure that we're evaluating them and that we're comparing them side by side with managers that are more larger institutional managers, and saying, well, where is the difference really? And one thing we've seen as a result of that is that we've gotten enough confidence to hire diverse managers for over 25% of our equity separately managed accounts. So we've been able, by just comparing them side by side, to say where really are the differences and what is the block that other people may have, and are we comfortable giving that manager the opportunity? Can they scale? Can they handle our asset size? And really, once you get in those conversations and put them side by side, it really identifies where you think the opportunities or the challenges may be. And as long as you have those discussions with that manager, I think you can get to a place where you're pretty comfortable. And we have been able to get there with a good portion of our active portfolio.
Thank you all. I'm going to start just going through some of the questions we've been getting. One, which is just a tactical question that is interesting. How do you do due diligence with the COVID-19 travel restrictions? How is that impacting your ability to scrutinize your investments?
It actually gives me more time because I'm not on an airplane or going to a hotel. I think it hasn't really caused a problem for me. Zoom is great, or WhatsApp, or God knows what. I think due diligence is a process. Most people don't know how to do it anyway. Most people look at due diligence as the way they think it is, as the way it want it to be, as the way it actually is. But yeah, so you're not meeting face to face with people, but you can do this. And to me, it hasn't made a difference one way or the other. The process is still the same. I think traveling is overrated.
Yeah.
Yeah.
Another question was, go ahead.
Oh, I was just going to say, one common theme I've heard over and over from both actual asset managers and other LPs has been just more reference calls. So just be prepared. And so if LPs did 10 reference calls, they're going to do 20 this time around.
Okay. Another question went to some of the earlier remarks from David Villa around potential inflation, right? Higher rates of inflation going forward. And then how do you think about your investment strategy in light of that? Are people thinking about commodities, gold, et cetera?
Yeah, we're not attracted to commodities or gold because there are not intrinsic cash flows. So we would prefer to buy the land like Robert did and pre-sell 25% of it and hold the rest. I think that makes a lot more sense to us than having gold that it's worth whatever you'll pay for it. It's not attractive to us. I think in terms of persistence, we've decided to use global tips for inflation. We think the likelihood of inflation in the next couple of years is very low, but because we don't have a cost of living adjustment, we pay the annuitants a bonus if we earn more than 5.5%. One of our biggest risks is inflation. So we have about a 16% allocation to global tips. And then we have 6%, I think we have an 8 to 9% allocation to real estate, which we think is another hedge. And then to some modest extent, there's inflation pass-through in equities, but it's not very strong. But that's our biggest soft spot in our structure, because we pay the benefit for the workers, the active employees, is wage inflation plus 4%.
Okay.
And for the retirees, it's 5%, but the COLA has to be earned.
Well, responses from other panelists on, do you agree that inflation, that you think it'll be low the next couple of years, or do you think it'll be higher because of the stimulus? And then how are you managing that?
I have no idea. Just don't. I don't invest that way because I never know. I have no idea. I'd rather do what David said we do, buy something if we get to pre-sell something and line that up nicely, it makes money. And that has nothing to do with inflation at all. Never does, never will. It just doesn't. So, people are still going to try to make money if there's high inflation or low inflation. The process is pretty much the same. No one's going to stop investing regardless of what inflation is.
And one thing I would add to what Robert said is, and David as well. I've been wrong on inflation for how many years now, since the financial crisis, where they lowered it. We knew there was going to be a period of deflation in asset prices, but at some point we expected some inflationary pressures, and it doesn't seem like the Fed has been able, no matter how hard they try, has been able to even achieve their 2.5% target. So I think in the current environment where asset prices where they are, I think it's going to be difficult for the Fed to continue to achieve its inflation targets in the near term. But my forecasting there is really not very good. So I think the idea is to build a long-term asset plan, but understand how you're going to adapt that plan if there is inflation that pushes interest rates higher, that increases that cost of capital. And that's really, as a trustee, I think that's where our focus should be, is rather than call a particular endpoint or call a direction, is plan for different scenarios and understand how we will adapt if they do begin to manifest in cost of capital and interest rates.
Okay. Let's see, we have another question going back to the diversity and inclusion about how do you measure yourself and what are your goals on providing opportunities to diverse employees and asset managers?
Are you evaluating based on a meritocracy or other stupid reasons? So if you're looking at, what's in front of you, make sure you're doing a rational decision based on what is good, as opposed to any biases that you should throw out of your head and slap yourself later while you're drinking a cup of wine.
Well, and what I would say is it starts by counting, just internally, and even asking that, the companies that you're doing business with to count, because they may not be paying attention to it. And if you ask them for, what is your head count? How many are women? How many people are color? What does your diversity look like? Just by asking those questions, I think it gets people to think about things that they haven't thought about before, or changes their perspective. So, we've done internally. We don't have any fixed guidelines, but I think we do continue to look at what does our workplace look like? How diverse are we? And I think my team has done a good job with that. I think Pennsylvania Treasury in general has done a good job at that. We can always do better, but it starts with counting. And if people aren't asking the questions and they're not tracking, they don't know whether they're doing it or not. And I think given the position where we sit, I think we want to be part of the solution rather than part of the problem. And I think, you do need to be cognizant of that, even if there are no set parameters and no set numbers that you're trying to achieve. Just say broadly, am I providing that opportunity? Are we training the people the way we want and bringing in, if we want a diverse workplace, how are we creating that?
Sure. Yes.
Yeah, I think this is a really tough question, because the way we are looking at it is that we're very much linking it to our returns and making better decisions. And we do believe that. We believe that diversity leads to better decisions and better returns for us as well as our managers. Now, how you measure that is can get really, really nuanced and very difficult to do globally, because diversity to one area may not be the same as diversity to another area, simply. But I think that the real challenge right now is that by any measure, the industry is likely really, really low. So on a practical basis, what we try to do is we try to look for areas to measure our partners in terms of how they are, how their diversity looks like within their organization, and at least understand across our manager set and our peer set, what does that look like? And then if it's so, what we consider so out of whack, give them sort of the aggregate data so that they understand where they're at, and try to lead them and sort of push them for greater diversity. But for us, it would have to be affecting the bottom line in the sense that we're looking for better decisions, better returns. And but I think that I guess by looking at the data, by virtue of that, I would just say that by any measure we're pretty far off, and so I don't think we're going to get really nuanced in this measurement game until much later.
David.
Yeah, I appreciate the comment that Robert made, which I understand is basically you have to make rational decisions, and you have to understand what your goal is, the results you want, and hire talent from that perspective. But I'm from Albuquerque, New Mexico. I'm considered Hispanic. My heritage is Mexican, and my genetics are 50% Native American. And I'm really frustrated that there's nobody else in Wisconsin in my team that looks like me. And I think that the racial diversity is too low. And I'd like it to be 15%, 20%, and it's probably closer to 2%. And I know it's really, really hard to achieve, but I'm not going to give up. I continually put pressure on my deputy executive director and human resources to address that. So I make them go to Columbia, and I make them go to California and UCLA and try to recruit. We don't have much luck, but I'm unwilling to give up. I think and I'm very much constrained by the fiduciary duty and duty of loyalty to the trust. Now, I'm also the treasurer of the Marguerite Casey Foundation, whose mission is to give voice to the poor families. And we manage very, very differently. We take huge risks in our hiring of managers and in hiring of staff, because we're mission driven. And so sometimes it doesn't work out, but the point I want to make is the foundation, whose mission is to give voice to the poor, and particularly poor families, is very much committed to taking risks that we're not as willing to take in the state of Wisconsin Investment Board, because we're not mission driven. We're managing the general account for an insurance scheme. So my other point is, in spite of how hard it is, I'm unwilling to give up. I'm always turning over rocks. It's one of the things I do when I go to conferences. It's how I found Dominic. Was at a conference, and it is very frustrating. And you know how hard it is, because when I talk about Girls Who Invest, you know exactly what I'm talking about.
And I can just weigh in one moment just to say, definitely it is building diversity is a long-term sustained effort. And we've had, all these intentions. We have about 20% historically underrepresented students. For those of you who aren't familiar with Girls Who Invest, it's actually, girls and young women young undergraduates who then get internships and education to go into the industry. We do partner with pensions. I've always felt that's an important part, and private. Margaret E. Casey Foundation is one of our partners, as well as other endowments. But yeah, we are also. I think there's been some Q&A. Are we recruiting from community colleges? I mean, that may be an additional opportunity. There's a lot of work and skill and expertise in actually reaching these students. Particularly, I think a lot of women check out, right? They don't like the industry. They don't like the reputation. So how do you build trust, come at them, in a way that you can explain it? So there's definitely challenges. I think I'm very optimistic that we're making some progress on the pipeline side. Robert.
I just said, do you mind? Yeah, so I don't want people to get the wrong impression. I used to work at a global engineering firm, and I was looking to fill a position, and it came down to two people. One was a white guy, and one was a black girl. And the guy who was looking to decide which one, he said, "Well, I'm going to go with the guy." I said, "Okay, why?" He said, "Why no? I just have a feeling." I said, "Well, grow up, hire the other one." I said, don't just do what you're comfortable with, and don't just do what you think is easy, because it's probably the wrong way to go about it and the wrong decision. And so, yeah, I don't just, hire just based on a meritocracy, based on that. It's not always cut and dry. So the guy that I work with, the developer, he's a French guy in Gatineau who is an Anglican. I'm a white Jewish guy from Australia. And, he barely speaks English, and I barely speak French, but yet we do a wonderful job together. So it's getting out of your comfort zone, because, if everybody in the room is agreeing with you, then, well, the old saying, you got too many people in the room, or the wrong people in the room, right? So I don't just say, let's do this, but I actually do it, and I get other people to do it as well. It's important.
And as Janet pointed out, it's not just about hiring at the top positions. If you want to get enough resumes so that you are, you're seeing a diverse applicant pool, you need to train those people. We need to get them in the industry. We need to provide the opportunity for them, and then develop those skills from the ground up, because that's how change happens. It doesn't necessarily, we're not going to snap our fingers and make it happen. And I think David pointed to that it's a process where you need to continue to push and push and push, and develop your talent and create those opportunities for the diverse workforce you want to see. And over time, you'll see more and more applicants come in that are qualified for those higher positions. Because one of my frustrations is I'd love to provide that opportunity, but the resumes just aren't coming in, and I think that's been one of our frustrations. So we've been working with our HR to identify new ways to recruit talent, and where are we posting jobs and those types of things. But it does start with making sure we're providing those opportunities throughout the organization and not just at the top.
I guess as a final, one of the other questions was, what are you most excited about in the markets and on the investment side? So maybe just if we do a quick round with everybody, close on that note.
So you just cut out the last bit.
Okay, so what are you most excited about?
Sorry,
just a quick
problem. I'll tell you, 18 months ago, I was more of a bio person. Now I'm definitely more venture.
Oh, okay. Well, I'm just excited that our return is back to zero. I think in March, our return was down 12.5%. I was stunned. I mean, I've been doing this since 1979, and boy, it was so fast, and the drawdown happened so quickly. I was surprised, and now I'm I'm excited because I've got back to zero, and I'm trying to figure out how to buy insurance.
What was the question? Sorry, you cut out.
What are you most excited about in markets?
Okay, so I just saw somebody in the chat say V-shaped recovery ? I don't get excited by this stuff. I find it fascinating. I just watch it and see where it goes, and if something makes sense to me, and it seems rational, I'll do it. If it doesn't, I won't. It's pretty, for me, I guess I'm not as constrained as the other guys for obvious reasons. But and I also don't have, going into every year, a deficit, so to speak, where I have to pay out, so it's comparing, it's not apples to apples, right? But I guess the perspectives are useful sometimes, but I don't get excited. And I find that when I do get excited, I have to, remind myself to be more rational, because when I get excited, I tend to put in my biases. So I go to sleep and I look at it again, and then I say to myself, I'm not sure why I'm excited by that. It doesn't look as good as I thought it did.
Is it just what we're excited about? Was that the question?
Yes.
Yes. Okay. I think I'm most excited about our staff. They've really proven to be really resilient in this shelter-in-place, environment, and we went fully remote in like a day, and I thought that was extremely stressful at the time. I think I probably turned half my hair white in that couple days, but we did it, and I'm really proud of the staff coming through this environment. I'm also really excited about the transactions and deals that they're looking at on a bottoms-up basis, as we're, again, doing a little bit more of a direct model, because I think something as simple as we're moving more into private credit and private lending, and essentially, if we're looking at ownership interest, it kind of looks like a sort of moderate return to maybe an equity-like return over time, over the long term, and essentially we're taking bond-like risk. So those things are super exciting. Like the panelists say, I mean, one thing that I'm personally excited about too is technology. I've covered technology for a long time. I started my career covering technology on the sell side. And what I've never seen is essentially, you talk about the S curve, the adoption phase, where we've just kind of shattered through that adoption phase and gone right into that steep part of the S curve in terms of adoption. And in some areas it will retract, but I think in a lot of areas it won't. You talk about e-commerce, the remote workforce going into the cloud, enterprise software, it's probably next. And all of that is, I've never seen that before. I've never seen us sort of skip the adoption phase and go right into that vertical S curve. So I think there's going to be a lot of disruption.
I completely concur with Scott there that, I'm most excited about the people on my team, the partners we've chosen that we're working with that made this all happen. And also the way we've come together to solve problems, at a state level, revenues remain uncertain, to say the least. But as somebody, at Treasury, we collect taxes, and when they come in each week, it's a giant question mark as to how much will come in relative to expectations. And even looking out ahead into the next fiscal year, what those tax collections will be. So I think but also we have assets, and then how do we deploy them so that we can provide the liquidity that hospitals need before the CARES Act funds come, and those types of things. So I'm just incredibly impressed by the talent around us, and that's both at Treasury and our partners who've helped us implement some of these solutions have been great. And as Scott alluded to, the technology and what the future of this industry is going to be is really remarkable, and I think we've gotten a glimpse of it. And I think all this comes down to the final thing that I'm really excited about is the intellectual challenges. These are all new problems that we're facing. both in the markets and outside the markets. And I'm just really excited about the ingenuity and problem solving that people are bringing to these problems. And I think it's reinvigorated me and my team and how we're approaching the markets. I mean, we spoke a little bit in our prep meeting about that the Fed was very quick to react and expand their facilities in order to support the markets. But also, what does that mean from an investment perspective, and how are people really using that and incorporating that risk in their models? There's a lot of new questions that I think will be answered in the coming months and years. And I'm really excited about the challenges. It's part of why I love this career. There's always something new to factor into your analysis, and you keep plugging away because you're always learning something new each day.
Did Jesus get his last shot?
I mean, I think it's been well covered. I think well said.
Okay.
The future is uncertain, but with a high quality team, you can do great things.
All right. Thank you. All right. I know we are out of time. So thank all of you for being on this panel. Thanks for all the folks who are participating in this session. I know you've got your final keynote coming up. So just if you have your clapping emoticon, give a hand to our panelists and thank you.
Thank you so much. What an insightful discussion. I love the different points made. If your schedule permits, panelists, we do invite you to a networking session that we have coming up next. Obviously, it's not required, but we would love your insight if you have the time. Thank you again for moderating, Janet. And just to give you sort of a overall in my feelings, understanding what was going on or what's going on in relation to talent. After 15 years in talent acquisition, I've interviewed over 15,000 people. And what everyone has in common is the reason why they're searching for a new job is because they can't find promotability opportunity. They want to make more money, or they feel like there's been an unjust promotion should have been next. So it is critical that those that are at your organizations understand that they're valued. So thank you for giving us obviously that aspect in terms of talent and the need to grow from within. For those of you that are just joining, welcome. Up next, we have a short networking break with a few investors and forum advisors, followed by the keynote fireside chat with Jose Minaya, CEO of Nuveen, and TIAA Company at 10:10 a.m. Pacific and 1:10 Eastern Time. Before we get started, we'd like to take this moment to thank the forum sponsor, TIAA Institute, for making it possible, and for the Hispanic Heritage Foundation to put this educational platform together. Now, let's get started with the networking session. Thank you for joining. Emmanuel Pleites, Dana Johns, Belinda Martinez Vega, Israel Munoz are going to join. So take it away. Let's have a conversation.
All right, cool. And so Rob or whoever from the last, Thomas, thank you all so much. Jesus, thank you so much. You are not required to stay on, but this is a little bit of an informal networking break. We had a break yesterday, and we thought we should fill it with some good conversation. So if you want to stick around, you're happy to. But joining us back is Belinda Martinez Vega, who I served as a trustee with at Alley Fire and Police Pension System a number of years ago. She is still there. I think you're like one of the longest serving trustees now ever. Which she now has a plethora of knowledge, even more than before, as she continues her tenure there. Dana Johns, thank you so much for being with us yesterday and for being willing to come back and offering yourself to answer any questions that are going to be submitted here. And we also have Israel Munoz. I loved your comments yesterday. You were one of the most, I don't want to say provocative, but forward thinking, right? Sharing what is happening in the state of Illinois. And I think something that maybe we could even tease out here during this break is, why is Illinois so forward thinking? How that happened? What are sort of the elements that came to the fore there? And I know that you've only been there a year or so, so you may not have the whole history, but I'm sure you've probably started hearing some of the war stories that have happened over the last couple of decades in Illinois to facilitate what you all are doing. And then Stacey Olivares-Castain, she's going to be moderating our fireside chat in about half hour, but she'll be kind of popping in and out here during this conversation. So I'm going to, just because of the folks that are still on, so Jesus, Rob, and Thomas, there was a question that Marcos Gonzalez asked, who's hiring? So maybe if you could just answer that question. Are you hiring today? Why or why not? Or will you be hiring in the next 6 to 9 months? And I think I'm going to preface that with saying Hispanic Heritage Foundation, aside from doing this Investors Forum program and all the 100 events that we do throughout the year, we are all about workforce. We're all about getting folks from underrepresented backgrounds into positions of leadership. And so, to the extent that we can facilitate anything to help you, to get you more resumes, to get you more talent, we can do that. That is what we do. And while some of our big corporate sponsors, obviously, they help us provide the resources, I think for public entities, we are always willing to essentially do it almost on a complimentary basis so that we can just get good talent into the best positions out there. So that's the first question. And then Belinda, Dana, and Isael, if you can also chime in on who's hiring. So let's see.
Do you want me to start or someone else going to start?
Go ahead, Dana, since you're
No. I was going to say, yes, we are hiring.
Awesome.
Hiring in a variety of different positions across the asset classes. We're building our team from an investment team of around, 18 right now to the whole team division will be 50 people. So I would love to connect with you guys. We are making it a concerted effort to reach out into our networks, whether it's my, networks at PE Win or 100 Women in Finance or, even networks like Twigo and SEO. And I would love to include you guys on my list as our job descriptions, come out, and I will totally send them to you. We are looking for, talented individuals. We would love to have, we ask our fund managers to have more diverse teams, whether it's, at their firm level or at portfolio company level, management teams and boards. But we too, as we ask them, look inside and want to make sure that what the constituencies that we serve, we reflect that, and we also believe in diversity of thought and, having different perspectives, around the table. It's incredibly important, helping us make investment decisions.
Awesome. Thank you, Dana. And so I'm sure that Jessica, Veronica, and Kelly, you're probably taking notes already. So I don't even have to say that. But what we will do is that we will grab any of those links of job descriptions or whatever you have, and we will be sending it out to not just the attendees of the last 2 days, but attendees that couldn't make it, that have attended all of our forums in the past. Right. And we'll push it out and have at least one big push in light of COVID-19 and kind of just, making sure we're kind of jumpstarting everyone to get jobs. So thank you, Dana. Let's see. Jesus, I'm going to call on you.
So currently, we're a small investment team. We have 6 investment professionals. So the short answer is we're not currently hiring. However, we do have a rotational associate program, which probably we will look to start recruiting a year plus from now. We have 2 currently that we hired last year. Okay,
awesome. Yeah. So if you have a link to the description of the program, maybe we can mention it so folks can kind of be attuned to it in the future. How about David? You still on? You're on mute right now. There you go.
Sorry, I said I was getting a sandwich. I was.
No worries.
What was the question?
The question is, are you hiring? And whether or not you're hiring, what is the hiring plan for the next 6 to 9 months?
We're hiring. I think we're recruiting 19 people.
Wow.
Over the next year. I think probably 4 of those are investment professionals, and the rest are investment service professionals.
Awesome. Okay. If you have job descriptions, or we can just pull them from your website, we'll follow up to get them. We'll push it out. Okay.
They're on the website. They're on the SWIB website.
Perfect. Awesome.
Yeah.
What about
Someone asked, I'm with the state of Maryland retirement system, so sorry about not identifying who I was with prior. And also, as David said, our job descriptions and job, they will be on our website as well. So,
Awesome.
State of Maryland website. So, sorry about that.
No. Thank you so much, Dana. Rob, I know that you probably have a small, nimble team, but maybe your portfolio companies as well.
Well, yeah, so that's pretty cool, actually. So I get asked by a lot of different people because I have quite a global network, especially with the kind of stuff I used to do before in different industries and different levels. And people say, do you know somebody who would be good at this or that? So my question is, what's the best way to tap into your resource? Is there a repository of resumes, or maybe it's organized into different categories? Does that exist?
But what we will do is that once we get the kind of incoming resumes for a lot of this push that we're going to do, we'll kind of collate them for you and send you here's kind of folks that are interested in investing or ops, and you let us know from there if there's anything to follow up on. Does that work?
Yeah, absolutely. Because as you know, a warm introduction is better than a cold one.
That's right. Awesome. Thomas?
Yeah, I currently have one position out there for a compliance manager, and also we are in the process of getting the paperwork together to hire a portfolio manager as well. So those over the next that's probably it for the year, given the uncertainty in the budget. But I do those are the two positions I expect will fill over the next 6 months.
Awesome. And how big is your team?
There's 25 people on my team.
Okay, yeah, so it's smaller on the smaller end, but that's great. Two roles that are available. Awesome. And then who else do we have? We have Belinda and Israel. I know, Belinda, you're a trustee, but I don't know how much insight you have into LA.
Right, I'm a trustee. So in terms of the fund, LA City, you can go to lacity.org and then do a search for any of the pension funds for LA City. We are always looking, especially for young, bright. We lose them to Wall Street, so we're always looking for young, bright people. Our chief investment officer is actually retiring soon, so we're working on a succession plan. So yeah, if I can make introductions, I'm happy to do so. I work at a law firm, so my email, and I'm happy to share it with everybody, is bmvega@venable. You can see the Venable on my thing, .com. And I'm also hiring a partner at my firm. So if anybody's going to law school, that's also something, a resource that I provide.
Awesome. Thank you, Belinda. Israel.
Hey, everyone. I'm with the Illinois State Treasurer's Office. I'm actually not involved with any hiring, but I just went on our website, and it looks like we have 3 openings. One is for a press assistant. Another is a manager of civic engagement. And the third is a deputy director for the Illinois Funds, which is a $6 billion portfolio we manage. So if you're interested in those, please reach out. You can reach me at mwvd@illinoistreasurer.gov.
Nice. Awesome. Thanks, Israel. Any thoughts right now? Any reflections? If you don't have anything that's kind of that you'd love to share, one question that I thought was really interesting that someone was saying is that talking about this kind of talent pipeline, talent issues, you all probably had a break at some point. How did you get in? Who opened that door? How did it happen? And I think a lot of the folks on the audience, maybe they want to be trustees one day, maybe they want to work at a pension fund, maybe they want to know how do they even interact with family offices. So I think if you don't mind maybe sharing a little bit about, maybe that pivotal moment and how it worked, right? And maybe what you did to position yourself for that.
Can I just add something? Even though I'm not Hispanic and I'm a white guy in Montreal, I live in Montreal, and I don't know if most people know, it's very, very French. And I actually had, for many, many years, did a lot of work with the Caisse de dépôt, which is the French Quebec pension fund. And most of them like to work with people who are French or speak French. Mm. And they were a client of mine. I collaborated with them for many, many years. And the main reason why they worked with me and they actually was okay speaking English with me in meetings is because when I said I was going to do something, I did it. It's pretty as simple as that. If you can provide value and show them that you can provide value, and what I mean by value in those situations is provide them with money so they can pay their pensioners, and do it in a way that is reliable and honest, then they will work with you, regardless if you don't speak French. But you just have to show that or be able to articulate it in a way, in very grounded ways that you can actually provide them with what they need.
Awesome. Thanks, Rob. And then before the next person, Eric Kachin mentioned in the chat that Northwestern Memorial Healthcare will be posting an ops analyst role when Illinois reopens and things get back to normal. So look out for that at Northwestern Memorial Healthcare. Thanks, Eric. All right. Anyone else want to share their big break? And before that, one more thing. I see Jose Minaya just joined. He's our keynote Fireside chat speaker. We'll start that in about 20 minutes. Stacy, who will be moderating that chat, is also on. And Jose and anyone else that is joining us in the last couple minutes, we're having a more informal networking session here with some of the panelists from the last panel that are staying on to kind of offer themselves to answer any questions. So feel free to submit questions. And otherwise, we're just going to have a conversation here, and we're kind of sharing a little bit of our pivotal moments in the career and how we were able to break into this industry. Anyone want to go next?
Jump in.
I'll volunteer. Oh, go ahead, Dana.
Oh, thanks. No, I'll do the Cliff Notes. I have a very untraditional background and path to what I'm doing today as a portfolio manager for private equity. The first decade of my career after undergrad, I worked in the art world. I was working in New York in an art gallery, and then when I moved to Baltimore, I was working for nonprofit museums. I did that for about a decade, and in early 2000, took a break. My son was 3, and I decided, because I'm ever a student of life, and I got another degree in computer science. My undergrad was so I was on the path to be a curator, not to be a portfolio manager. But I do have to say, just about the breaks, when I switched from, working in arts administration, I found a position in a local private equity firm. And I kind of worked my way up back from the bottom. I was leaving the top, but I had found private equity to be fascinating, and I knew really nothing about it. And I had some great mentors. So I think mentors are really important. If you can connect with someone who can really grow you. I spent 9 years at Camden working on, and it's also about timing and serendipity. They were just creating a fund of funds. So I got to grow with that and watch it be built. And 9 years later, then I switched to Maryland. So I do think and along the way, in those first 9 years, it was building your network. It was developing the relationships, which is what our job is about, right? I mean, I think, at least half of it is about being able to develop relationships. The other pieces of it, the more technical side, you can go to school. I ended up going back and getting my master's in finance while I was working at Camden. And, those kinds of opportunities, while I was in business school, I was still working, I could marry the two. So when I got to Maryland, it was kind of an opaque process. I really actually didn't know what position I was applying for. Today, they actually are much more specific about what you would be applying for. But when I got there, they could clearly see I had a skill set that they needed, and they were building their team at the time. So again, I think it was timing. But it's been an amazing platform to work on. And I've been at Maryland for 9 years. And I've again, at a time when we were growing the private equity portfolio, which is what I'm focused on, to look back almost 10 years later and kind of see what we built. And then to think about 10 years forward, it's really exciting because I think there's, no one knew COVID was going to be, kind of part of our reality today. So while we were thinking about what does the next decade hold for us in January of 2020, now that it's more exciting, it's more uncertain, but, we're working with really great managers, and we hope to work with, even, more new managers who, the next generation, because clearly, that is what fuels, kind of outperformance, is to be able to kind of identify who's that great next gen, who's that Robert Smith, who's the Jose Feliciano, as they've grown their platforms in a really incredible way.
I could also maybe share on my experiences just because they've been a little more recent, and I just found it really interesting. So I went to college I went to Fordham in New York City. When I was there, I'm a kid from Southside Chicago, and I got a chance to go to New York. And being in New York, I was like, I want to know what Wall Street is. And I was able to do really well in school and got internships with investment banks. I completed 2 investment banking internships, wealth management internships, and also completed internships at the U.S. Senate, working for a senator. And then after I graduated from college, I decided to do a Fulbright scholarship. So I went to go do business in Mexico City at a tech startup out there. And when I came back, I did an apprenticeship at a VC fund, a relatively new one called Chingona Ventures. However, this was in about August, September of last year. And at that time, I was still looking for jobs. And I was looking in the financial industry, things in banking, things in asset management. And I took dozens of interviews, and every single person would end up telling me, oh, we just don't think you have the right qualifications. And it really astounded me because compared to many other college graduates, I had an extremely competitive resume, and I kept interviewing with people who didn't look like me, and they kept telling me that I just didn't have the right experience. So I thought that was just an interesting situation for me. I actually had to work as a busboy for several months just to make some money. And then, fortunately, I had known Rodrigo Garcia. He's the chief investment officer for the state of Illinois. I'd known him for about 2 years at that point. And I got this position because I had built a relationship with him over time. He knew I was talented. And when he had that, and when he learned that I was looking for a job and his office was hiring, he told me to apply. So I did, and here I am. But I think it's important to also recognize that there's a lot of extremely talented young people of color out there, and that talent isn't recognized because of the bias that exists within the financial services industry.
Israel, it's not in the financial services industry. It's absolutely in everywhere. Industry.
Yeah,
and it's shitty and it sucks.
Yeah,
it is. But you've as I can't remember who else said it. You've got to expand your network, find people that have the same values as you. Because quite frankly, you don't want to work with those people anyway, because they will not value you. And even if you get into them, they will still look at you in a way that is not equal to them, and you don't want to be a part of that. So build a career with people that have the same morals and values as you, and you'll be a better, happier person, and you'll probably succeed more.
Absolutely.
Let's go to Belinda, because I know Belinda.
I just want to say both Robert and Dana, good points. And you can find your mentors anywhere. The way that I got my job, I started at O'Melveny and Myers, was an African American partner came to my law school. And if he had not come to my law school to interview for first years, because it wasn't even career day, I would not have gotten that opportunity. And the way that I got my opportunity at the LA Fire and Police Pension, frankly, they were looking for a woman who understood finances. They hadn't had a woman on their board. I don't know how long, Emmanuel, a pretty long time. So, and the first time I met with the mayor, the first time I met with his deputy director, they didn't think I had the chops. The mayor brought me back, Mayor Villaraigosa, and said, I want to see her. So, you can find your opportunities with people, of like Robert, other people that share your same values, and that's how you're going to succeed.
Thanks, Belinda. Maybe Jesus?
Sure.
I'm picking on you because you hinted at it earlier.
I was about to say, look, I'm very thankful for Giancarlo Mark, who was a panelist yesterday. And, I started through an internship at CalPERS. And if it wasn't for that internship, I would not be here, let's be blunt. And frankly, I think a lot of what's been said has been resonating. One, networking. I mean, every job I've gotten post CalPERS has been through networking. Treating people with respect, even when they're disrespectful to you. I found that to be extremely valuable. It's almost like winning people over with kindness, and because there's been some really disrespectful people in the world. But you know what? Memories are long, careers are long, and it comes back to bite them usually. And frankly, I think of guys like Jose Feliciano, who I met in 2002 when he was still at Tenenbaum. It's pretty amazing to see how people like that, individuals like that who are driven, have a different approach to the world, provide value, have just been super successful, and there's a whole lot more out there. The only other thing I would just add is one of the reasons for moving back from Canada is actually to figure out how to give back to the community and to be mentorship. So I think figuring out how to get more involved in that, I think is something that I know I want to do. So, I throw it out there that, but I will say one of the most challenging parts about that is the volume, because time is probably the most valuable resource for everyone on this call. And so I think I've personally taken the approach of I do few things deep. So I just throw that out there. LinkedIn's a powerful resource as well. So
thanks, Jesus. And one thing we like to facilitate with HHF is some of these charlas that are more virtual, that allows someone like Jesus or Belinda to be 1 to like 20 or 30 or more, right? So that there could be a little bit more active Q&A to make sure that we value your time, Jesus, and anyone else that's open to do that. Maybe Thomas and David? David?
Yeah, one thing I would just add on top of what Jesus just added is embrace what makes you different. Because when you're in these positions and you're scanning through a lot of resumes, each individual is going to have a unique path they took to get there. Understand what that is and what makes you different from the other people, because that's really going to be, I think, how you bring the diverse insight to the organization. Because the people you want to work with are people who appreciate diversity of thought. And if you can help them understand, yes, I check these boxes for the minimum, for the requirements, but also I bring this unique perspective. That's really what is going to set you apart from, I think, some of the other talent pool as well. In addition to, as Robert alluded to earlier, the warm recommendation is always better than a cold one as well.
Right. David, anything to add from your end? How'd you break in?
Yeah. So I had been in operations for about 10 years. And then in 1989, I came back from London and I started studying for the CFA credential, Chartered Financial Analyst credential. Been out of school about 10 years, and I figured I don't want to go back to university, so I'll get another credential. And in 1989, Gary Brinson bought his business from First Chicago, and I was on the team that sold the company to him, which was a leveraged buyout financed by Hellman and Freeman. In the process, I discovered an accounting error which cost Gary quite a lot of money. He had to pay quite a lot more for the company based on the error that I found in the valuation work. He was quite upset. So 3 years later, I get my CFA credential. It's about 1992. And I call up the chief operating officer for Brinson Partners, Sam Anderson, and I said, I've been out of school a long time. I've been in operations. I just got my CFA exam. What can somebody like me do? And he said, can you come right over? So it's like 4:50. I go over to the office at 5:30. And I meet with Gary Brinson and Sam, and I thought, oh my God, Gary's going to be really upset because I cost him so much money back in 1989. And he said, David, if you will fix my back office, because it's like a submarine that's gone too deep and the bolts are popping off. We've grown so fast in the last few years. If you will fix that, I will help you bridge into asset management. and you can use your CFA exam or your CFA credential. So I worked in operations for about 2.5 years, and then Gary moved me into the asset allocation team. And I spent about 12 years at Princeton Partners. And that's really how I broke into the business. I think there's two stories there. One is you work hard, you're very reliable, you're dependable, you don't make mistakes, and you dedicate yourself to a life of learning. And I think in my case, those two things paid off, because at Princeton Partners, I basically got the brass ring. I think 6 years later, we sold the firm to Swiss Bancorp.
Nice. Thanks for sharing, David. So now to maybe end it here before we get Stacy and Jose Minaya on, but we'll go around the horn again. Some of you are younger than others. What is your next 5 to 10 year? What is your 5 to 10 year plan? Where do you want to be? Who wants to go first?
You know me. I've got like every 4 years I look at my plan.
There you go.
You know, I was at O'Malveny for a long time. I was there 10 years. I didn't make partner. I left and had a child. And I went to a couple small law firms, and now I'm back at Venable. It's a good, respectable, 100 top law firm in terms of, 100 top firms. And so I'm looking to be equity partner. I am non-equity. In 5 years, I'm going to be equity partner, develop a practice for 10 years. And then I might try to become a judge. We'll see.
Nice.
I want to be exactly where I am now and make sure that I can only continue working with good people who have the same values as I do. And if I think that the people around me are starting to have different values or morals, I steer away, because that's never a good thing at all. So I don't, making money is one thing, but if you're not doing it with people who you love and trust, it'll bite you in the ass one way or the other. It's like the old scorpion and the frog, right? The scorpion doesn't change his nature, even when they profess otherwise.
I agree 100%, Robert. I think I could go next. So right now I've got about 5 months working as a investment analyst for the state of Illinois, for the Treasurer's Office. Previously, I was a Fulbright scholar, working at a tech startup and learning more about VC down in Mexico City. In addition to my current role as an investment analyst, I help lead an angel investor network here in Chicago, but our members are nationwide. It's called Angeles Investors. We are the only, I believe the only, Latinx, Hispanic-focused angel investor group. And that's on the investor side as well as on the startup side, because we know that diverse entrepreneurs have a much tougher time raising capital. So we want to ensure that people of color are using their capital to back people of color who are starting companies. So I'd like to grow that organization out more, eventually go to business school, and hopefully continue that mission of closing the capital gap and supporting diverse entrepreneurs.
Israel, I know we kind of connected, but send me that information about what you just said and what you lead and run. We'll chat about it, and I'll make introductions for you.
Thank you. And it's called Angeles Investors. I'll connect with you on LinkedIn.
Yeah,
and,
you got my email. You got my email. Send it to me.
Great.
Thanks, Israel. All right, who's next? We got a couple more minutes here.
All right, I'll just quickly say that I love what I do. This is my second career. A lot of people don't get to have two full careers. I've been able to marry them a bit. I guess you would say the skill set. So I see myself in the back half of my career, continuing to do what I do. I love working at Maryland. I love our platform. If you don't see me at Maryland, it's because I'm continuing to do what I do at Maryland, but somewhere else. I would love to continue to support diverse managers, support women-founded fund managers. It's a bit of a passion, and I'm fortunate that Maryland, through TIAA program, enables us to have that. I won't call it a mandate, but a mission to make sure that our portfolio is diverse. Through Terra Maria, I think we have 13 billion committed across all of the asset classes. So we've made a strong statement around Terra Maria, but I just like to continue it, grow it, build it, make it better.
Awesome. I think we have three left in 2 minutes. Who wants to go?
I'll say in 5 years, my goal is to be playing jazz guitar on a rotating basis in Madison, Chicago, and Orlando, Florida, and if I'm lucky, maybe be on 1 or 2 corporate boards in the asset management industry. But I'm definitely at the end of my career, and I'm just about finished implementing the strategy that I set out to implement in Wisconsin. So
awesome.
It's time to start using all the guitar collection I've accumulated.
Awesome. Thanks, David. Thomas, Seuss?
Sure. What I would say is I'm certainly mid-career, and I love my position. I think I've learned so much about the operational side of investing, being in the CIO chair that I didn't see as a PM, and having to manage that as especially in a public funded environment where you have constrained budgets and those type of challenges. But those challenges, help you think about things differently. So I'm really excited about what we're implementing. We've had the opportunity to expand into electronic trading and move into a 21st century trading operation, and we continue to roll out those changes throughout the organization. And we're doing a lot of really exciting things here. I'm just excited to continue in my position, provide opportunities for others, and collaborate with really wonderful people. And so I don't anticipate my chair moving until there's a new treasurer, and I may not be asked back. So I'll continue to do what I can here until there's an opportunity to continue doing it elsewhere.
Awesome. Thanks. Jesus, last.
I'll make it easy. I will likely be in the same chair I'm in today, learning about what it's like to manage an endowment, family office, and with the pension background. Hopefully I sit on a couple of endowment foundation boards and go from there. We're going to have to make more equity, because ultimately the only way to make wealth is through equity.
There you go. Stacy and or Marta, thank you all. I'll hand it to you. And last, thank you to the panelists, and thank you to TIAA Company and Institute and Nuveen Investments for being behind us here and facilitating with resources to make this happen. I'll hand it to you.
Thank you so much, Emmanuel, and the rest of you. Exciting conversation, insightful. I feel like there was a call to action. Now we have a pipeline, resumes that are going to be flowing, people who are going to become investors. I already sent a message to Israel and as you know, obviously, Stacy, you've stayed, so thank you so much for that and being a part of that conversation. So now we're going to transition into our keynote Fireside chat. Friendly reminder, questions, comments, etc. We have a chat at the bottom window. There's a Q&A. Please go ahead and add your questions there. Moderating the keynote Fireside chat, we have Stacy Olivares. Stacy is serving her first appointment to the CalPERS Board of Administration. She was appointed as the board's insurance industry representative by Governor Gavin Newsom back in August 2019. Stacy served as the senior advisor on impact investment and blockchain at the state of California. She was developing democratized and decentralized impact investment models based on emerging blockchain technologies. From 2011 to 2017, Stacy was the managing director and chief investment officer for the California Organized Investment Network, an impact investment fund directing insurance company capital in investments that yield competitive financial returns and environmental or social benefits to California's underserved and rural communities. During her tenure, listen to this, The value of insurers' coin holdings more than quadrupled from 6.6 billion at the beginning of 2011 to approximately 28.6 billion at the end of 2017. Building ventures and investments that yield strong social and environmental impacts is Stacy's passion. Stacy is an alumna of the University of California, Berkeley, and Harvard University. Stacy, this is all you. Thank you.
Thank you, Martha. Such a kind introduction. Well, now I get the honor of introducing Jose Minaya. And Jose, thank you so much for joining us today. We really appreciate it. This is such an absolute treasure. So, quite an impressive background. Jose Minaya is Chief Executive Officer of Nuveen, the investment manager of TIAA. Nuveen manages more than $1 trillion across equities, fixed income, and alternatives. And it was one of the first in the industry to practice responsible investing. Jose joined TIAA in 2004 as a portfolio manager. And since then, he has held several leadership positions at both Nuveen and TIAA, including serving as president and chief investment officer prior to becoming CEO in January of this year. So felicidades, Jose, that's amazing.
Gracias.
He also had, it's so exciting to have you in the CEO role. I can't even tell you. And you also have been a recipient of the 2016 Twigo Blazing Trails Award. You're on the board of Twigo and on the board of Dartmouth's Tuck School of Business. So you've been giving back for a long time. You are definitely blazing these trails. I can't wait for everyone to hear more from you today.
I'm looking forward to it.
Great. So I would love for you to provide a little bit more background on yourself and your path to becoming CEO of Nuveen.
Sure. And by the way, could you guys see me okay? For some reason, I can't see myself on my screen. I'm assuming you guys can see me.
Yes, we could see you, Jose.
All right. Terrific. Well, I'll start out by saying that, look, I'm a first-generation American, so my parents emigrated here from the Dominican Republic. And I was very fortunate to have a great family home, strong family values, work ethic. There was a point, though, where, a limit to what my parents can do for me, right? They weren't oriented in the world of finance and they weren't educated themselves. So my path to where I am today was largely led by curiosity and self-exploration, right? I think I've also had many humbling experiences. When I was younger, I was a very good baseball player. I was on a path and thought I was sure to be a major leaguer until I wasn't that good as I thought. And it was kind of humbling because it was a recognition that you can work really hard at something, but sometimes, certain abilities are not going to get you there. So as I went to school, I started out as an engineer. People told me to do engineering because I was good at math. Yet as I again asked around, I kind of felt like, well, engineering is not something I really want to do after school. It led me into finance and econ. And even as I found my way there, the next discussion for me was, okay, well, what about getting a job back in the early 90s, which it was tough. And I had an affinity to giving back to my country, given what they had done for my parents and for me. And I had applied and got accepted into the United States Marine Corps Officer Candidate School. Terrific experience, but again, one that kind of led me down a path that said, well, I don't think I want to do this as a career. So then as I started looking for roles and jobs, a lot of it was me asking around, what are some of the jobs out there in finance? And a lot of it kept coming back to investment banking, being very prestigious, working on Wall Street, doing M&A. So that became my focus and saying, okay, if this is the best, that's what I'm going to try to do. And I was fortunate to get a job at JP Morgan doing M&A in investment banking. I think, again, once I was there, talking to my peers who had very different experiences than mine, a lot of discussion around everybody was taking the GMATs and going to business school. I had no idea what a GMAT was, but it sounded like it was the thing to do. So that became my focus in going to business school and doing well on the GMAT. I think when I was in business school, and it was another humbling experience because I always felt that, look, I'm a smart guy, but even if people are smarter, I can outwork anyone. And you kind of realize, well, that's not really the case when you're around very talented people, but it was a reflection of got to look inward,
and see what are my strengths and make sure that I play to that. As I looked at the more broader world of finance, I was really kind of attracted to the investment side. I'd been working with companies on the M&A piece, but you always removed yourself away. I was like, I want to be closer to kind of understanding how firms work and liking the side of investing. Then I went on and had several roles in different firms, starting out as an equity analyst for an emerging market fund at AIG. I then went on to the credit side and was a fixed income portfolio manager. And then ultimately, I spent the majority of my investment career on the private side, private equity alternatives. I think then that takes me in when I joined TIAA. It was a unique time because at the time, TIAA had about 10 billion in assets in alternatives, about 300 or plus billion in total AUM. It was looking for growth. It was looking to diversify its balance sheet. And I was one of these people that was always very curious and thinking of ideas and things that I wanted the firm to think about. And I was fortunate that I had people that encouraged me around me, especially at the time, the current chief investment officer, where as we were looking at different esoteric asset classes, I was often someone that was tapped. And then it kind of led to, the growth of alternatives business, which is, I started out by trying to grow a natural resources business and platform around agriculture, which was interesting for a kid from Washington Heights in New York City. I knew very little about farmland, but what I realized quickly that across anything that I did, it was the same fundamentals I was applying. And I think I've always said good investors are really good at knowing what they don't know. Mm-hmm. And for that meant kind of doing several acquisitions, bringing out platforms. And then they asked me to do it with timber. They asked me to do it with real estate. I eventually ran our entire private markets, which led to chief investment officer and obviously today CIO. So I've been very fortunate to kind of go on this journey and see it the whole way through, because I step back today and look, we have over $1 trillion in assets under management and over 300 billion in alternatives. And it's we're a very unique firm because it's a mission-driven organization. Right? TIAA is over a 100-year-old firm. It's a not-for-profit, so it exists solely for the benefit of its clients, participants, and stakeholders. So it drives, it really lives its values. And then being at Nuveen, which is a for-profit entity that's owned by TIAA, we still share those values. So again, it's one of these things where it feels good to come to work. There's always a new challenge every day. And I just kind of feel very fortunate to have kind of risen to my role in leadership at a firm, which I've kind of been able to go on this tremendous journey.
That's great. I mean, it's such a remarkable story too, and such great exposure too in your career across all asset classes. I think it's wonderful that you have that exposure and we're so intellectually curious and willing to challenge yourself.
Yeah, no, I mean, I think for me, that was kind of the key all along. Like I said, I went a long way where I didn't have that background. We talk a lot about diversity. I think inclusion is a big part of the D&I story. I think, have I felt sometimes discrimination in the workforce? I have, but to be honest, very little. I think the issue is more with inclusion, right? Because that curiosity and looking to acclimate, what I realized very quickly, and I heard that there was a previous discussion that I was hearing from a young man that resonated with me. A lot of times you could have a lot of these great qualifications and you wonder, why am I not getting looks? Why am I not being hired? People hire people that they feel comfortable with, that they share the same experiences, right? I still remember my first days at JP Morgan. Almost no one there was from my undergrad. Most of them shared very different experiences. If they were talking about their golf game or their trips to Europe, on vacations, it wasn't something that I knew very well. So that in conversations, it might have been harder for them to make the effort to be included. And often if people were going out for a few drinks or something, if they didn't include you, I don't think they were trying to exclude you. It's just, okay, look, it's easier to hang out with people that kind of share your same experiences. And I think that was both a challenge, but I kind of took it on as an opportunity as well.
How do you approach inclusion in your role as CEO?
I think the biggest thing to me, there's two things in inclusion. I think one is awareness, right? So I think often a lot of people would say, no, I very much believe in diversity, but they may not be aware of some of these, whether it's a bias or just kind of recognizing that, look, if there's four men in a room and one woman and you're all talking about sports or other things that you're connected, are you aware that, you are excluding this other person that maybe doesn't have those same interests? So I think the first thing is awareness. The second thing is creating an environment that is kind of fostering and looking to include people in its very nature.
Right. So much change right now in the markets. What is your outlook for the asset management industry over the next couple of years?
My outlook, even given I think the COVID environment and even the volatility we're seeing today, my outlook hasn't really changed. Like, I think that the industry as a whole will continue to grow, but there's several headwinds that have been out there that now in this current environment, I would say have even been accelerated, right? The first one is the need for scale. What you saw last year and the year before was an unprecedented level of consolidation and M&A deals. That's because cost pressures are going up. Higher regulation is driving higher costs, and the active to passive movement, which is driving fees lower, is also going to continue, and that's driving that pressure. So if you don't have scale today, it's becoming a more challenging environment. The other one is what we're seeing from artificial intelligence and the use of data, right? And it goes back to this fee pressure of, look, the industry is becoming more efficient. So while you've seen active to passive, the other concern you have is like, well, look, investors are still looking for alpha. So that role of how do you create more efficient delivery models that allow some level of alpha at a lower level of cost that you're seeing at the purely active side. I think the other one is alternatives in the diversification of portfolios, because clearly the demand for that area has been growing significantly. And it's one, because what clients are looking for more today is this viewpoint of, how do I protect myself against volatility?
Right.
But how do I, better correlation? But then also in a lower interest rate environment, how do I get better income exposure? Clearly in a COVID environment, that's going to be the case. And you're seeing a lot of asset managers quickly scramble through acquisitions of trying to build out a broader breadth of capabilities that goes closer to the alternative side. I think the other one is digital, right? This is an area where, especially with millennials, the world's been predominantly driven by face-to-face traveling, meeting clients at their home offices. More and more, it's been around investing in digital, around how do you get a better client experience by getting better information on your client, but more importantly, how do you kind of access them without having to have this tremendous amount of travel? I think this COVID environment, I tell people when we come back to the offices, I'm someone who traveled 200 to 300,000 miles a year. The idea of me going to Seoul, Korea for 40 minutes for a finals meeting, I don't see that happening going forward. And I think that's a good thing. I think it's kind of more driving efficiency. But again, it's a tremendous amount of cost in developing that. So again, it goes back to having winners and losers. Another piece would be, what's going on in the retirement issues around this country, and the need to have more pension-like types of products for our clients. The term lifetime income. This is something that's, TIAA is very big on it, but looking at how do you include annuities in your target date funds or some kind of annuity type component in the everyday person's portfolio. And then lastly, and I think this is a big one, it's the demand from an ESG perspective, right? That narrative has dramatically changed from one that was predominantly screened and product led to one basically clients stay asking about the ethos of your firm and saying, how do you incorporate ESG holistically? And it's the two forces of, I think it's driving investment performance as well as the demand coming from the client segment is pretty strong right now.
On that note, with responsible investing, I know there are a lot of definitions of what that means, responsible investing or ESG, and it continues to change over time. And I think millennials are definitely pushing that definition, and that's a great thing. How do you see the intersection right now between financial security and ESG? So one of the things I hear frequently, and I don't agree with it, but it's a common, I think, misperception, is that if there is any environmental or social benefit, then there's additional financial risk or lower financial returns. What's your experience been with that?
Again, I think this is part of what I mean by the narrative is changing. If you go back historically, and I'll use TIAA because, we've been in the space for now 50, maybe I haven't been, but the firm's been in the space for 50 plus years. And that began at a time of apartheid. And our stakeholders, our clients really kind of caring about it. It was really of the, okay, if you want to invest in this, it may cost us a little bit more to do this, but we can create a portfolio for you that excludes, companies that are correlated to that. And if you have issues with fossil fuels or guns, we can create products to do that. Today, we have over 40 billion in those types of products, right? But you're right. At the time, it was around exclude this. And by the way, which is portfolio theory 101. If you put a constraint on a portfolio, if you look at the efficiency frontier, you're going to lower your return, expectations. I think what's happened now is that it's become a bottom line issue, right? So I think as we evolved as a firm, looking more at ESG from a risk perspective versus just kind of a client demand perspective, is recognizing that there is alpha in ESG, right? Being underweight PG&E prior to the wildfires, and it being rated pretty poorly from an environmental perspective, that helped our returns. Understanding and evaluating weak governance practices at Volkswagen, and then seeing two CEOs go to jail and seeing what happened to the stock of that firm. Again, these are things that, in our opinion, it drives alpha in your portfolio. So I think that stigma still exists, and I think it's one of these things that it's more around the education of coming up with the analytics, the data that kind of shows the attribution analysis around, hey, incorporating these risks is good for your portfolio, not just good for the world, right? So I think my viewpoint is 10 years from now, if not sooner, there won't be any ESG-driven products, because I think firms are going to be held to the fire really to how they manage that holistically throughout their firm.
Have you seen any data that you could speak to for our attendees on what the long-term performance is of those companies that have strong ESG metrics?
Well, I would say that today, there is data out there that will show you, for example, even on the social side and diversity, that firms that have more diversity perform better. If you've avoided, climate change risks, you've done better. The problem is that, again, that research is pretty new. And I've gone through this multiple times in my career where there were esoteric asset classes like investing in farmland. And we could prove using information, but the information maybe was only 20, 30 years back. And you'd have our quant guy saying, without 100 years of data, you could bootstrap this all you want. It's not going to give you a strong explanation to the model. Yet you can have a gut feeling behind it. But I think as this is now increasing from a demand perspective, I think you're going to see a lot more, supporting information. Because we saw this in real estate 40, 50, 60 years ago. Most of us couldn't get exposure to real estate. Why? Buildings were bought because you needed to put people in them. And then that evolved. And today, any one of us can go to a broker and get exposure to real estate. And there's a ton of research out there. ESG, for the most part, has been this sort of just viewpoint of, okay, I want to exclude investing in X. So you create a wrapper. And by the way, your returns are going to be lower and your fees are going to be higher. That narrative is just changing. And I think a lot of the focus, I know we have been, we've hired several data scientists. Several years ago, I didn't even know what a data scientist did, right? And today, most of my peers and firms have this, and it's around kind of looking at this information and saying, okay, the same way we may be tracking, earnings growth on companies or how they deploy CapEx or the amount of debt, ESG is just another one of these factors.
That's interesting. How do you see diversity within the context of responsible investing in ESG?
Well, I think diversity is a big component of ESG, and it's kind of really tied behind the S part of ESG. Well, the first easy part, as I mentioned earlier, there's a lot of research out there that is conclusive in this particular case. It kind of shows firms that have more diversity at their board, at their C-suite, tend to outperform those that don't. I think the other perspective is the perspective or the purview that you bring to your firm, meaning we're a pretty large global firm today. I've seen my firm grow from being US-centric to today being 34 plus countries. And there was a lot that could be lost in translation when you're establishing people and teams and culture in Brazil, in China, in Germany, in Singapore. And at first, it was that nature of like, we didn't really have a lot of international people at our firm. And, it'd be very easy to lose that foresight and say, here's how we do things. I think it's the same thing across the board. And you look at the social issues we're having today in our country. It's going to be very hard if you have a firm that has no diversity, right? Because how are you really going to try to understand what the real issues are and how you best serve not only your employees, but your clients? So that's critical. I think the other part is now it's become more of a bottom line issue, right? Again, it was when I came into the workforce, it was, affirmative action. It was more around, hey, it's a nice thing to do. Today, with the globalization that we live in and the demographics that have been growing across our own country, having that, again, diversity of thought and perspectives, it's clear now to people in the C-suite, it's a bottom line issue, both in terms of practice, but again, even more in terms of the awareness of clients and society as a whole that are demanding this as well.
Do you see that shift moving global capital markets?
I'm sorry, say that again?
Do you see that shift in terms of diversity as part of ESG, in terms of globalization, beginning to shift global capital markets? I mean, if we look at the global capital market system we have now, a lot of it was predicated on a lack of diversity, for lack of a better term, and disparity. And so now there are several questions I'm hearing about, well, what happens if we have less disparity? Will we actually become stronger as a nation? Will we make markets stronger? Will we strengthen global economies?
Look, I think it's absolutely begun to take shape, right? I think one, you're seeing it again from a bottom line perspective where it's affecting people's businesses and they have to respond, right? Mm-hmm. Clients have enacted kind of their voice and companies are aware that, hey, this is something that is not just the right thing to do, but we need to do. And so you're seeing it live. Now, I think because it's still a long way off, a lot of firms may have the will and the intent and the soul for it, but not understand how to really do it. I mean, I look at my own firm as we were looking at goals to increasing diversity. And one simple example would be I used to chair our military veterans resource group, employee resource group. And our firm had a strong kind of intent and dedication to kind of helping that community and increase kind of how we, bringing in more veterans into the firm. Then as I got involved, I found out that, when our veterans went off to do reserve duty, we docked them vacation time. And it was just a policy and it got buried. And it took one call to our head of HR at the time to say, I can't believe we do that. Change it right away. But these are things that kind of could stay in practice. And even though firms have strong wills, if they don't really truly understand the best way or what diversity means or how you attract, people of color or gender, I think there's a big education gap. And I think that's something that, I think it's improved, but it still has a long way to go. And I would say, even an example, some of the social issues we're seeing today, and especially with the protests, it makes me extremely optimistic. And I think I've surprised people when I've said that, because to me, look, I grew up in an environment and in a neighborhood where that was just normal. It was the same way of kind of learning the perils of crossing the street. You learned all these other things of like, hey, be careful for this or for that. And it wasn't as much scary as it was just normal. And obviously that's horrible. It shouldn't be that way, but it was always out there. What you've seen through different movements and Dr. Martin Luther King and others is that awareness has been brought out. What's different today is the iPhone and videos. And humankind as a whole is good. And I think now that these things are out there, people will be forced to address it. And by the way, even if they thought they understood it, I've talked to so many people, my neighbors included, that they might have heard of these things, but they didn't understand it. Right? I think about diversity that way a lot, that a lot of our firms very much have an intent to improve diversity, but the reality is, so they really understand what it means.
We have a lot of trustees attending this conference, and I would like to get your perspective for them on how you see pensions performing and being able to provide financial security over the next 10, 20 years.
It's a term I overuse, but again, in this particular market, as proven it, I think diversification is critical and keeping a long-term mindset. I've been asked in the past often, what keeps you up at night? And I would always say that we blink, because I've been through the global financial crisis. I've been through Brexit. I've been through multiple different of these environments. And every time, we make the memos of saying, if this happens, if the November elections were like this, Brexit was like this, where, we create the memos that say, if it goes this way, but by the way, that'll never happen. But if it goes this way, here are the 20 things that we'll do. And then exactly what we thought wouldn't happen happens. And there is that moment of panic of, okay, what should we sell? What should we move into? Fortunately, every time we've been able to take a deep breath and say, look, it's always been about what's our long-term vision? What are the key fundamentals? That hasn't changed, whether it's COVID or anything else. And in this case, we do know how it ends. In other cases, we didn't. Here, we know there's an end to this. And this is the time where you get pushed to your discipline of, hey, are you really a long-term driven investor? The fundamentals are still going to shine here. And I think it's this other piece of thinking about diversification a little bit differently, right? I think, this is where alternatives, I think, play in a really important part of how are you going to, in a world that's lower for longer and now even longer from an interest rate perspective, how are we going to solve the retirement needs in this country with, 10-year treasury below 1% and potentially for the foreseeable future? So there's going to be a little bit more of kind of creativity between private and public assets and portfolio construction. But ultimately, the bottom line is maintaining your investment discipline and your viewpoint as a long-term investor, and thinking about ESG as well. Because like I said, I'm a firm believer it is a alpha generator for your portfolio.
You talked a lot about diversification and how that's so important in order to maintain performance for the pensions and provide that financial security. Do you see asset allocation shifting more towards, for example, alternatives and away from fixed income? I know in this current environment, it's low interest rates, so we see much more of that happening. But do you see that as being more of a long-term shift?
I think it's a shift that's already begun. And I think it's one, and it's one that now through COVID in this environment, it's going to accelerate, right? Because in many ways, the reason it's taken a time for this shift, and what I mean by shift is, again, introducing alternatives more in a portfolio, is that for all the reasons that alternatives are attractive, it was a lot harder in a bull market. Because if you can just get mid-teens return by investing in equities, especially in an index in a low fee way, well, why would you need to introduce a liquidity or higher fee products? So I think that part of it is going to, without question, accelerate. I think tax is now becoming, and now for pension funds, this might be a little bit different, but for individuals and others, I think taxes becomes another issue here, because then if you start moving from equities to more fixed income, yield-oriented alternatives, now you introduce tax. So now how you think about using tax strategies and munis in the mix are also going to, I think, change a little bit around portfolio construction. But I think it's mostly been an education gap, because it's interesting to me that over the years, every consultant I met with, it was like, oh, everybody's more interested in bringing on more alternatives. Yet there was a gap in the education around what does it really mean to have illiquidity or something that's more liquid. I had the bias of, I say, look, in a market that's selling assets at 20 cents on the dollar doesn't sound like liquidity to me. Or this other issue of you can buy a middle market loan that today is yielding 5-6%. That might not have seemed that great 3-4 years ago. Right. Today, relative to the volatility it brings you, the idea of kind of bringing on some of these investments that might be lower return, but more stable and better correlations, I think, again, is going to continue to drive that mindset.
What are some of the best resources for trustees and the consultants that serve the pensions to really educate themselves about alternatives and the forecast over the next 10, 20 years?
I think the best resource really, in my opinion, what I've seen and how we've worked with other trustees and pension plans is partnership, right? Look, there's a lot of research out there. But where we've seen our own business grow as well as our partners is when there's true partnership. Meaning, I've always said, look, Nuveen and TIAA were unique because we're both an asset owner, an allocator, as well as an asset manager. And often I've kind of approached some of the, we're one of the largest investors in the world, and a lot of our peers and partners are as well. There is strength in that power. And, being able to connect in a lot of the platforms we launched, often we're 3, 4, or 5 other pension plans that were very similar and like-minded to us. And as they were thinking through this, we would say, look, every issue you have and you're talking to your board with or your investment committee, we have the same one. We have the same issues, whether it's liability matching, whether it's duration-based. We have very similar profiles. Getting together and kind of understanding how this plays into your portfolio at the ground level, I think it's a huge opportunity, and one that it's generally afforded to most of those trustees and pension plans, just because they're some of the largest investors out in the world.
And that's why we have conferences like this, so we can bring people on to help educate us too. And I think it's just as diversification is important in a portfolio, I think diversification of thought is important too, and that we get knowledge from multiple sources.
No, I think that's critical. I think, when we think about diversity, you got to think about it in a pretty broad way, because the reason it's so important, it's for that diversity of thought.
Wow, that's great. So anything else you want to share before we get into the Q&A?
I just kind of more generally for me, when I kind of look back in retrospect, look, what's been important for me in my career path and what I do today has been that curiosity, has been that ability to know that I'm better if I surround myself with people who their strengths complement my weaknesses. And I think it's the same thing no matter where you sit. If your ego can withstand the idea of sometimes bringing folks who are better than you are around you, I think that to me is something that I always keep to heart and keep in mind.
Yeah, it's a lesson for all of us. So it looks like we have one question so far. Which trends are you seeing in asset allocation, and what percentage of institutional asset allocation will they be? So looking at private equity, private credit, and ex-US investments, how are you seeing that shift change? So more pension portfolios go into private equity, private credit, ex-US. And what do you think the ideal allocation should be?
I think first in terms of what I'm seeing with the trend, it's absolutely been increasing, right? I think the issue has been more around scale. So today, when you look at, private credit, private equity, it's more of a question of everyone recognizing this should be an attractive vintage. And typically coming out of these environments, it has been. Yet, you'll still see a period of time where a lot of these firms are going to have more dry powder, or the inability in the current market to deploy capital, and it's not as scalable. So I think as firms have kind of now have rethought things like, okay, real estate might be late cycle, but you know what? Multifamily and industrial and logistics is pretty strong, and they're pretty underrepresented in most portfolios. Again, back to the ESG piece, where this is an area where you're seeing a big trend in money inflows. As a matter of fact, our ESG ETFs has been one of the biggest kind of flows we've had throughout this current crisis, and it's very telling to me. We've done some surveys, and one recent one we did, we surveyed private wealth, a private wealth group, large representation, and the question was asked: would you shift all of your entire portfolio to more of a ESG focused portfolio? And 50% of the group responded yes, and that really surprised me that many would. But when you looked at the millennial segment, it was 94%. I mean, again, that's going to be a trend that will continue. I think the question towards what should the right allocation be, that really depends on the individual or the pension plan or the system, what they're looking for. I typically, if you think about Sharpe ratios in alpha, I typically look at the world and say, well, when you ask the question, should I take on any illiquidity risk? The real question is, you should take on as much as you can, right? Because ultimately, the reason you're getting a premium, right? If you have the ability to take on illiquidity risk, by almost, when you model this in efficiency frontier models, it always skews because it tells you to go like 90% there, because ultimately that illiquidity is driving a much higher Sharpe ratio. You could see it even within sub-asset classes of loans versus real estate. The more liquid even the alternative is, the less kind of the Sharpe ratio you're going to get. So it really depends, but ultimately it's really about how much illiquidity you can take. And then I feel a lot of firms sometimes put too much of a price tag on the liquidity premium, because again, some of these asset classes are a lot more liquid than you think. And I look at, owning them for environments like this, where again, selling something at 20 cents on the dollar does not strike me as good liquidity.
Thanks. And we have another question too. Does TIAA have minority-owned broker programs?
We I believe we do. We partner with a few, especially on the trading side. We've started our own impact fund that has included to kind of providing capital and even lending to some of these environments. So it's something that we've begun. I don't think we've done it. We haven't done it in mass scale, but we've had, whether it's minority-owned banks, community banks. We've done microfinancing overseas, and this was an idea that came about because as we thought about transitioning and thinking about what we do from an impact investing and ESG, and this belief of, hey, there's returns in this, we said we got to put our own money where our mouth is, right? And we launched this impact fund that today it's about a little bit over $1 billion, but it was only started several years ago. There's a great example where we've been able to it's been a, call it high teen, it's a private equity style fund, but it's been a high teens return. So we've been able to see, but more importantly, we've learned a lot. So I'll give you an example. We invested in several years ago in a smart glass company as part of that portfolio. And today that company is doing very well. But more importantly, when we refurbished our office in New York, we used that clean glass technology, and several of our real estate platforms use that technology. So there's a lot of this connectivity of how we've kind of been able to say, hey, this is not just about talking about it. It's not even risk factors. There's a lot we can still learn around how does our money really make an impact, and very importantly, still make a very good return for our clients.
That's a great point. I've seen a lot of that with the Green Building Alliance and the insurance companies spending a lot of money to make sure that their commercial real estate has a pretty green footprint. And on the footprints, so you mentioned AI, you mentioned digital platforms, and now we're in the middle of COVID. How do you view the implications of a decrease in physical footprints?
I've got two kind of very parallel views on it, right? The first one was very surprising to me, is that, coming out of this, and we moved almost 17,000 employees literally overnight on a work from home. And that was across the globe, whether it was India, US, so on and so forth. And there was a little bit of that hold your breath moment, because while you practice these contingency plans, you really don't know how it's going to go out until you're actually implementing it. And I will say, from an operational perspective today, and I would say it's probably from a lot of the peers that I speak to, they experience the same thing. It's been flawless. We've had very little issues in a work from home environment. There hasn't really been issues even engaging with clients because they're in the same situation. So there's been a little bit of this new normal. Now, what I do get concerned about is the mental health side of this, right? I can tell you that at the front end of this, and we continue to see it, the morale across my firm was at an all-time high. People, doing the Zoom happy hours, the kind of engaging. I've always said to our folks coming into this that we will be judged, and it's not just being judged by how we manage our portfolios. We're going to be judged by how we deal with our people, with our clients, and the communities that we serve. That's been great to see. But from here on, I also have the folks that work for me that are in a 700 square foot apartment in New York with 2 kids and working out of their laundry room. People have elderly folks at home. I think as this goes on longer, there's going to be a bigger toll and strain on that. But what I am more optimistic about, and people will say, hey, we're going to lose something in the lack of interaction. Well, look, I think we will all be going back to the office soon. I just think going back to the office is going to mean something very different, right? And we're all still going to be able to interact and we're all social beings, as human beings. And I think that will continue, but I think we'll likely be more efficient about it. Like I said, I may not be going to Seoul, Korea, because I need to be there for a 40-minute kind of meeting and then head back. I think the workforce will be a lot more flexible in how they use space and think about space.
Great. And we have another question. What are your thoughts on how we can make wealth creation more accessible to lower and middle income households?
Yeah, this is a really important issue, especially on the TIAA side of the house, right? So if you think about it, and again, I think we're probably a bad example, not the best example, because we're a mission-driven firm, meaning we have a high net worth or wealth advice platform. Yet the average, if you think about who TIAA serves, is the universities, everything from the person in the cafeteria to the janitorial staff to the professors. The average net worth for folks that get that advice is about $100,000 or so. So not what you would see in other platforms, but again, our firm exists to kind of provide services to our participants. But even I think what we're doing is the same thing that's going to start happening across other firms, which is you see robo-advisors. Again, back to digitalization. It's this idea that the stats are pretty clear. People that get provided advice do infinitely better than the folks that don't, especially throughout the different crises. And if you really nail it down, the biggest reason is they're advised not to sell off their portfolios at the wrong time. So I think kind of the way to get more access, and I think the industry is working its way there, again, is providing it's technology, it's the digitalization, is that ability for people to get advice, not necessarily having to be served by an individual and sitting in an office and the cost that comes with that, but that ability to serve a lot more people with the right level of technology and digitalization.
Question on that too. So bringing together technology, scale, access to low to moderate income households, and the mental health point you mentioned earlier, especially as a result of COVID and going virtual. I know a lot of the trustees are concerned about providing access to healthcare, particularly mental health care. What types of investment opportunities are you starting to see open up when it comes to digital mental health or virtual mental health?
I think the way we've looked at that from two ends, one with our folks is that focus of how do we provide access to resources for our own associates and employees. And in many cases, we led with, town halls that were led by medical professionals, again, numbers and things that our folks can get access to it. I think, on the investment side, it's also given us an opportunity, whether in not just in mental health, but across the whole healthcare platform. We were able to participate on the real estate side and converting certain real estate buildings into the ability to kind of use them as hospitals, especially when they were needed. But it's things like providing credit tenant leases to the VA hospitals. It's things like funding a school for the blind. A lot of these things. Our capital is coming in. Again, it's not, and this is not charity. It's just kind of these areas that maybe are underserved by the capital markets, and being able to come in there with our capital and saying, hey, we can help underwrite, whether it's debt, equity, or otherwise, that helps kind of fund these particular initiatives.
Any other trends you're seeing when it comes to digitization, global scaling, and where you think pensions could start looking for investment opportunities?
Yeah, I think the biggest trend we see today, again, is on the artificial intelligence side, right? And again, it's that need of, okay, how are you going to get that additional return on an efficient basis? So I think that's the first place that, this kind of quantamental or the quant side is showing up a lot more. But I think it's going to be a challenge, right? Because even though that is accelerating, I use the same example, the challenges that I face, right? I can look and say, this is a trend that I know without question in the next 5 to 10 years is going to transform the asset management industry. But the thing is, I could be very wrong in that 5 to 10 years. It could be next year, or it could be 20 years from now. And it's hard to say how you start kind of investing in this and building the tools without the other side of the market isn't exactly there yet, right? So there's kind of an interest, there's a need, but it's that demand supply kind of game of kind of how does it come together?
So one more question, it looks like here. One piece of advice you would give to the 22-year-old Jose Minaya. How do you get into the industry today?
I would give 2 pieces of advice, right? I think to me, and I've had a lot of folks ask me, is it too late for me to get into this industry? Or, it's very competitive. My viewpoint is like, look, if you have a passion for it and you stick to it, there's always a way. That being said, if you say you have a passion to it, but you need to be in New York, and by the way, you need a certain kind of title. Well, that's going to be harder. If you're willing to move somewhere unknown to you and start at a very low point because you have a passion and you want to do it, I think follow your passion, because everything else, at least in my opinion, what I've seen, not just in my own career, but in others, you usually don't go wrong when you follow your passion. The other advice I would give is embrace adversity, right? Because as you go through your career, there's a lot of smart people. And, I think what's kind of helped me at different moments of my career, progress, it's not when I was doing well in good times. It's like, yeah, hey, Jose smart, wow, he's doing a great job. There's a lot of people doing a great job. It's those times that things go really wrong. And people see you in a different light when that happens. And that's the time when people go, oh, wow, okay, they can handle this. And a lot of times I always say there's a burning fire, a burning house. Some people run out of it. At times you should be the one to kind of lean in and go in and say, hey, I could be part of the problem. And I've been in those situations, and some of them media related, investment related, where others come and say, look, we can help you here, or maybe you could take a step back. And I very quickly was saying, look, this is something I can handle. I own it, and I want to be responsible here. And when people see you in that light, that's when they start thinking about you in a different way and saying, okay, you can handle this. Now I can trust you with bigger things, because I know you can do things when things are cool. It's when things are hot that you get an opportunity. So a lot of times, as we're in a COVID environment, I myself was told, wow, it's too bad you became CEO, this year, and now here's what you inherit. In many ways, while I would never have wished this COVID scenario, I do view it as an opportunity, because I think to me, this is a great opportunity to say, hey, a better way to be judged and show how leadership really stands out in times like this.
That shows tremendous strength of character.
Thank you.
Well, I know you have a hard stop at 11, so I want to be very respectful of your time. And we are incredibly grateful for all that you do at Nuveen and TIAA, and for being here today to provide this keynote. I think you've inspired a lot of the younger generation and provided so much great information for the trustees.
Great. Well, thank you. I really enjoyed it, and I also appreciate the opportunity to engage with you all. Hopefully, some other time we can do it face to face.
Yes, that'd be wonderful.
Yeah. Well, thank you.
Thank you.
Thank you, Jose. Thank you, Stacy. I'm inspired. I wrote, if you have a passion for it and you stick to it, it will happen. Most definitely a mantra that I live my life by. Well, thank you again both for this dynamic fireside chat on behalf of the Hispanic Heritage Foundation and sponsor TIAA Institute. We thank you, all of our speakers, and those that have joined us today and yesterday. This concludes the 7th Annual Investors Forum. We will be sharing the link to the recording of the forum over email. And this is in an effort to also serve our community. We will be sending you a short survey for you to fill it out. We ask that you take a few minutes to complete it. Have a great rest of your day. Y nos vemos for the 8th annual. Thank you all. Hasta luego.